Boom. All right, there we go. Yo, what is up for everyone watching this on the YouTube replay? I hope you're having a great day. Hope you're having a great Sunday. Let's start this stream off by giving you a quick portfolio update. Then I'll get into some of the stocks that I think are pretty attractive because a lot of stocks right now really are too expensive. Like, I can't recommend a lot of these popular names like AMD, some of the Mag 7 right now, like Microsoft, Reddit. But there are some stocks that are not at all-time highs right now that do look pretty attractive to buy now. So I'll get into those in a minute here. But yeah, let me start with a quick portfolio update. This is called my buy and never sell portfolio. That's what it's called at the top because once I buy a stock in here, I'm literally not allowed to sell it. And that's why it's done so well. Like I'm up 800% on this stock right here. Like most people, if they're up 100, 200, 300%, they'll at least trim a little bit. But I'm not allowed to do that in this portfolio specifically. I'm just not allowed to trim or sell. So thankfully, it's worked out pretty well. It's actually my best performing portfolio ever. I'm up 55% just since January 1st, which is pretty crazy. But yeah, Tom, we did. I sold. I got out of my oil name MUSA and replaced it with Moog MOG.A. This is an aerospace and defense company. My new holding in here. So yeah, this is my Moomoo portfolio. We also have a Webull account right here. This is just my risk on account. I don't really have any rules in here, but yeah, we're only up. I love being fully transparent. We're up 17% all time in here, so we really haven't done too amazing. But this past week was phenomenal for some of our biggest stocks, like AMD specifically. It's like an NVIDIA competitor. AMD hit an all-time high. People used to call AMD advanced money destroyer. Now this is like advanced money duplicator or something. This thing's at an all-time high. I can't believe it. But certainly wouldn't be buying it at current prices. Here are actually my most recent purchases in order. So these are literally the stocks I've just recently bought. I bought Ouster, Uber, Microsoft, and AppLovin. Those are my four most recent purchases. And I literally did these 2 weeks ago on 3/27. It's 4/20 today. So, or 4/19. So basically I bought these stocks 20 days ago and I can't believe it. In just 20 days, we're already up 12% on Uber, 17% on Microsoft. I mean, for the Mag 7, for the market cap that Microsoft has, this is insane. I can't believe I'm already up 17% just short amount of time. So yeah, I actually want to go over finally my Robinhood portfolio. Then I'll go over some stocks that I think are attractive to buy now. Even though the S&P 500 is at an all-time high, there are some deals out there still currently that aren't at all-time highs. So yeah, here's the S&P 500 the past year. S&P is up 36% the past year, and in this portfolio, we are up 32%. So we've slightly done a little worse than the S&P 500, but still, I'm not complaining about our performance in here. We're up 0.03% year to date, and these are all the stocks that we own in here. If you look in the top left, it's called my dividend-only account because every stock in here pays a dividend. Here's my total percent change on every stock. So luckily, we are green on every single holding in here. And here's our total equity in each stock. So my largest holdings are at the top. Like Google's my largest, and then we got 5 shares of Meta. That's my smallest holding. So yeah, we also have a Roth IRA. Last portfolio, I promise. Yeah, here's my Roth IRA right here. We started this exactly a year ago, and we're down 2% all time. We haven't done too well in here. We're trying to bring the growth back to our Roth IRA, but we have some kind of popular names. Like we got Webull in here. Actually, yeah, not many popular names in here, but yeah, this is my Roth IRA. So yeah, I want to get into some stocks now that even though the S&P is at an all-time high, there are a few companies that aren't at all-time highs that I think are pretty good. And this first stock is ABBV. It's a healthcare company. So if you don't have any exposure to healthcare, this is one of the best names in my opinion, and you get a good dividend yield. So if you buy the stock right now, if you buy AbbVie right now, no matter what, you get 3.3% of your money back and a qualified dividend every year. You can get in at a better cost basis than me. I bought 3 shares at 219, and well, it's at 208 today. So you can definitely get in at a better cost basis than me. But here's what I love about this stock, and here's why not only you're going to get a 3.3% dividend, but you're also going to get, in my opinion, 4 to 5% of your money back in stock price appreciation on top of that. Here's my thesis on why. So AbbVie, this is a prescription company. They sell a bunch of different prescriptions, and their largest one right here is Skyrizi. This is one of the reasons I'm so bullish. Like their largest prescription is growing like a beast. It's up 33, after grew 57, after grew 52, after grew 75. Like that's what's going to justify the stock price appreciation, not just Skyrizi, but their second largest holding or prescription, I mean. That's up 30 after 46. I mean, these year-over-year growth rates in the middle, it's always growing like 30 to 50%. It's so impressive. So that's where, in my opinion, you're going to get that extra stock price appreciation from. And it's not like they're expensive. They only trade at 22 times forward PE, which means they only trade at 22 times next year's net income. Why are we looking at next year's multiple? Because they had a one-time adjustment last quarter, making the PE ratio look really expensive. It's not actually that expensive, hence the forward PE of a 22. So yeah, I love the dividend. I love the stock price appreciation. And I think on average, you should get like 7 to 8% of your money back every year just for all of time with this stock right here. So yeah, I just bought this one a month or two ago. So yeah, that's Avi right here. And then I have another stock that's kind of bit off all-time highs, but this one does not lack in growth. So this is Progressive right here, an insurance name. And someone said, hey, what's up, Nick? Yeah, what's up? Hey, try not to spam there. Hold on, man. Logan, chill out there. NVIDIA, are we looking red? Hey, what's up, Mr. Snow? What's up? Big man, it's good to see y'all. So yeah, so, and what's up, Tom and Charlie? Good to see y'all too. So here's Progressive right here. This one has historically had really good stock price appreciation. The stock always just grows like 10, 20% a year. And I just bought them for the first time ever a couple months ago. So yeah, they're definitely off their all-time high. So, the S&P is at an all-time high, but this one isn't. And that's why I think it's pretty attractive. And I'm not just recommending this stock because they're off all-time highs. I'm recommending this one because of their quality financials and their quality fundamentals that really impress me. So check this out right here. First off, they're not even expensive. They only trade at 12 times forward PE. So they only trade at 12 times net income. That's kind of normal for insurance companies, but check this out right here. Here's what's so impressive. Or if we just go up here to their personal lines, this grows very fast. It always grows double digits. It's up 12%, after grew 5, after grew 24, after grew 5. So they're on a good little streak of growth there, but not just growing their revenue, but also their bottom line net income. If we just zoom out, they're the most profitable they've ever been. I mean, the past 4 or 5 quarters, they're making literally 2.5 or actually 2.8 billion of after-tax net income every quarter. So it's super impressive. And they also pay a dividend. The cool part is the special dividends that they do. So normally they only pay you 10 cents a dividend a quarter, but they just did a special $13 special dividend. And I own 4.5 shares. Check out what that gave me. I'll show you my dividend income. So that dividend literally gave me, I normally only get 40 cents in dividends a quarter, but every single year they do a special dividend and I got a $55 special dividend just out of nowhere. I wasn't even expecting that. So that's what's cool about Progressive. They trade cheap at a 12 times forward PE. I guess they're saying robo-taxis and stuff might hurt insurance, but that's not scaring me out of the stock. It's worth it to probably have as a teeny sized position, and it's in a nice defensive industry. So yeah, Logan, we'll get into Poet here in 1 minute here. Please give me a second here. I'm up 60% in 2.5 weeks. Dang, luxury, yo. You're doing pretty good, man. So yeah, those were some of the recent picks I think that are pretty decent. I might go over Calm-Maine as well. This is a chicken egg commodity stock. There's also Sprouts Farmers Market, but this one is kind of being out-innovated by Amazon right now. Yeah, we're down pretty bad on Sprouts Farmers Market, but the reason the stock is falling so much isn't like because they're missing on their numbers. Like they're printing that income. They're the most profitable they've ever been, expanding margins, buying back 3% of the stock a year. They're just falling because of just sentiment. Like they're just, I don't know. So that's another cool one. So anyway, I want to go over HQ. Yeah, then we'll go over POET. Yeah, here, Logan, remind me. I got you. We'll go over Poet after this. So let me go over HQ right here. So I've actually not heard of this stock before. Horizon Quantum Holdings. Looks like they just IPO'd a month ago. So maybe they're in the quantum industry. Okay, so I should know what flag that is, but I don't. Is that Singapore or something? So this is not a US company. So yeah, actually they're headquartered in Singapore. So this is a Chinese stock pretty much. And they don't report in US dollars, but they also just IPO'd. I'd be super, super careful with this one. There is no forward PE. They're worth 600 million. They're Chinese. And for the first half of 2025, for the first 6 months, they only did 40,000 of revenue. And they only have 4 million of assets. So this one looks super, super risky. No way. Actually, check that out. IONQ is the largest shareholder. And then Tencent is as well. The Chinese company Tencent that I love. But yeah, IONQ, that's another quantum stock. Looks like IONQ is a big shareholder of that one. Interesting, but I wish I could give you thoughts on that one, but they literally just IPO'd and there's no real fundamentals I can look at there. So I do apologize, Charlie. But interesting there, I guess, if you wanted to swing trade some of the quantum hype. My favorite quantum players are like the higher quality market cap ones, like Google, Honeywell. They have the money and the talent to be the industry leader, and they already are the industry leader, especially Google right now and their quantum. I mean, the number one best quantum play is Google, but it's not exactly a pure quantum play. You know what I mean? So maybe like some of these other momentum stocks, but it is the best. So here's Poet right here. They're worth $1 billion, $1.1 billion company. What do they do? Non-recurring engineering services. So they have no revenue pretty much. So this company did 340,000 of revenue this quarter, 200K the quarter before, and they lost 50 million on that or 40 million. That's 4% of the market cap. I would be super careful with this name. They're worth $1 billion and they're doing 300K of revenue a quarter. Or what do analysts project? Okay, so that revenue is supposed to grow. It's supposed to go to 1 million. So that's good. But they did miss on revenue the past 2 quarters in a row. So this is just really risky. They lose net income every quarter. They're barely having any revenue. Oh, and they're in Asia. So they're actually headquartered in Canada. Poet Technologies. Maybe we can go to their website right here. Looks like maybe some sort of AI software. Or products, yeah. What do you got? Oh, no. Maybe they do like semiconductor circuit boards, stuff like this. I guess here are their actual products right here. So it looks like all these stuff are, this is the kind of stuff that's being bought by data centers. So there might be a nice data center tailwind here. Looks like the industry, what was that? Industry was optical communication, low altitude economy. Anyway, I'd just be real careful with this one just because the revenue is so tiny. But I wonder what the future growth projections are. Okay, hey, happy Sunday, Cup. Can't decide on AbbVie or HCA. That's a good one. Truthfully, I got both of those. I own HCA Healthcare. That's my favorite healthcare name. It's actually a hospital group. So HCA is the number one hospital stock. The AbbVie sells a bunch of different prescriptions. Yeah, that's ABBV. So hey, why not own both part of the healthcare industry? From the hospital to the prescriptions. Eli Lilly is another really good one. Eli Lilly's big on weight loss prescriptions. AbbVie's also getting into weight loss prescriptions. I wonder if we can find any news on that. Weekly news. Nah, no news. But I know they are working on a weight loss prescription right now. All right. Did I look at the wrong POET? Photonics related to NVIDIA. So I'm thinking whether Poet might partner with NVIDIA. Oh, that'd be interesting. Oh, okay. Photonics. Okay. Yeah, actually, NVIDIA, they've been doing a lot of deals with like Lumentum recently and some other company. NVIDIA's been doing some heavy investments. All right. Yo, what's up? Someone said, Rodney said MAIR. Let's check this one out. Sorry if I'm missing out on some stocks here. We'll try and get to all these. Okay. Yeah, actually, we won't really cover this one. They literally IPO'd yesterday. So whenever a company just IPOs, normally they rally up a bunch initially, then they fall down a bunch. But let's go see what they do exactly. So, wow, 3.5 billion in revenue for the full year. So, building products and equipment. Oh, wow. So, design and manufacture of indoor HVAC systems, commercial and residential. I'm actually a big fan of HVAC right now. Madison Air. Actually, thanks for this stock right here. I own Comfort Systems, the number one HVAC play. I wonder what this one's like. Actually, I'm going to put them on my watch list because I'm a big fan of HVAC. Own the whole part of the data center trade. Don't just buy NVIDIA that sells the chips. Own the HVAC people who cool down the chips. Own the nuclear reactors that power the chips, and also own like Amphenol, the one that makes the optical and the copper cables for the actual GPUs. Maybe own the manufacturer, which is Taiwan Semiconductor. So, why not own the whole AI ecosystem? And that's what I do. Hey, what's up? Paul says, can you look at SPGI next? Yeah, that's S&P Global. This is a really cool credit rating company. They have like a shared oligopoly. Like there's Moody's and then there's S&P Global for the credit rating industry. They have a nice dividend too. If you buy the stock right now, you're getting 1% of your money back a year. And the forward PE is pretty attractive for the quality that S&P Global is. If you've ever heard of the S&P 500, that's who owns that. And every time a index fund uses S&P, they have to pay royalties back to this company. So yeah, they have a 27 forward PE. Yeah, they're in many different industries. And actually, this app that I'm on right here, this brokerage pays S&P Global. If you look at like the second line here, this data is sourced from S&P Global. And it's not just because I'm on S&P Global stock. I'm talking about like these orange estimates. So this brokerage pays S&P Global as well for all their like ratings and insights and indices, all that. Market Intelligence. How's that growing? Market Intelligence. Anyway, I think this one's just fallen recently just because of like they're a software name, just like uh, they're a software name that's being hurt by the AI thesis. If you look at just Microsoft, Adobe, ServiceNow, all these kind of software names are falling, but this one is specifically way more immune and shouldn't be falling like the software names because they're in these like niche industries like credit ratings and indices and all that. So they print money. Here's their after-tax net income a quarter. I mean, they're printing money, and the trend is up and to the right. They're making easily over 1.1 billion of after-tax net income a quarter. Fortress balance sheet. What about the free cash flow? Yeah, really good, over 1.4 bill of free cash flow quarter. So I have no complaints about S&P Global. Yeah, it's actually pretty attractive to even buy at a 27 forward PE for the quality that they have. It might be like fairly priced. It's not like super cheap, but it's like fairly priced right here, if not like slightly cheap, you know? So yeah, I'm a big fan of that one. Hey, what's up, Plasma? Good to see you, dude. Hope you're having a good Sunday. Hope everyone's having a good Sunday. So someone said GE Veranova, Vertiv is good. Oh, wait, actually, let me do Taiwan Semiconductor. What's up, Nick? So let me do Taiwan Semiconductor, then we'll do HCA. Oh, what's up? We'll do American Superconductor. Yeah, and what's up, Zachariah? How's it going, man? So here's Taiwan Semiconductor. So NVIDIA just designs the chips. Apple just designs their smartphone chips. Taiwan Semiconductor is the one who actually manufactures them. They're the fab play, and they actually are moving some of their manufacturing to the US now. Taiwan AI chip capacity sold out through 2026. Wow. I mean, Taiwan enters 2 nanometer chip mass production. I mean, there's just infinite amount of good news on Taiwan Semiconductor. And if you look at the stock, you'd think, okay, this is really expensive. They're at an all-time high. But here's why they're not like technically expensive. This forward PE is all that you want to look at. This is why if I was a shareholder, you do not trim or sell this position because in my opinion, it's just going higher. In 1 year from now, they're only going to be trading at 22 times net income. That can easily stretch up to like a 26, a 27 forward PE. For the quality that Taiwan Semiconductor has, that could easily send this up to like $450 to a crazy new all-time high, and I think pretty easily. So even though it's at all-time highs, do not trim or sell your position, in my opinion. And they have the number one market share, 71% market share. Their number one customer is NVIDIA. Their second largest customer is Apple. And check out the revenue. So the total revenue was $35 billion. On this 35 bill of revenue, they kept after tax 21.5 billion in net income, which means their net margin is a 60%, 50 to 60%. I mean, they literally are collecting royalties. You go spend $100 on one of their chips, they keep basically $50 after tax. And check out the future net income projections. Net income is supposed to be 19 billion, 21 billion. Like everything's just up and to the right. Revenue is going to go from 32 bill to 43. So the growth is not done. And that's why the stock is at an all-time high. It's not just because of momentum. It's because of the real fundamentals and the cheap valuation. I really feel like the forward PE of a 22 could stretch up to like a 26. And you get a 1% dividend yield. So Taiwan Semi is one of my favorite stocks. I'd love to own them. Sad I don't own them. So, yeah. Would you buy the S&P 500 now or wait a few weeks? Yeah, if you literally plan like me to just diamond hand and never sell for 10 years, it's worth it to just go ahead and buy now. But if you want to try and get a better entry cost, I mean, it kind of is better waiting because it is tough buying the S&P 500 at an all-time high. But for all of history, that's been the right move. Every time it's hit an all-time high before today, it's always been the right thing to do has been to buy because it's only been up. So in the long run, it's the right move. But I would dollar cost average. So let's do American, or what's DOV actually? Should we do Dover? Let's do Dover. I've actually haven't heard of this one, I don't think. So I guess this brokerage is telling me, what is this right here? There is, I guess, a double bottom forming, 95% rise probability. Oh, well, I like digging into the fundamentals, and actually the valuation is cheap. Even though the stock is at an all-time high, just like Taiwan Semiconductor, I mean, the valuation isn't even expensive. They only trade at 23 times next year's net income. And what do? So they're in pumps and process solutions, clean energy, climate sustainability, imaging and identification. So they're actually in a lot of niche industries. How's the pumps business growing? Wow, that growing nice double digits is up 22 after 7 after 6%. So the growth rate's growing on their pumps. I wonder if it's like data center pumps they're selling right now. So they're a dividend aristocrat, which means they've rose their dividend for over 25 years. They never had to cut their dividend once. And they've only risen it for 25 years straight. Not even they never had to cut it during 2020 or 2008. So yeah, it looks like the revenue's starting to come back. Looks like the revenue kind of has been flat for a couple years. Since 2021, the revenue's been flat, but I guess the future sentiment is good. I mean, what's the dividend? You get if you buy it now, you're getting 1% of your money back in a dividend, 23 forward PE. So that we kind of want to see the growth come back. Looks like the analysts are expecting good growth. Revenue is going to go from 2 to 2.18 and 320 mil in net income. That'll actually be a record net income. Looks like the slight one-time adjustment last quarter. So yeah, here's their actual profits. As you can see, it's like kind of slowly growing single digits over time. Maybe that's why they're at like a 23 multiple, because the revenue's not growing crazy fast, but it's still quality. And I bet you that their pumps business is probably benefiting from data centers right now, if I had to make a bet. Looks like they're also in hydrogen energy. Yeah, they were in some clean energy and stuff. What app is this? Hey, this is a brokerage. If you'd like to get this app I'm on with my affiliate link, it's on my link tree. That very first link there. All right. Hey, what's up, Aaron? Dude, Aaron, good to see you, dude. Hope you're having a great Sunday. So, Dot said Microsoft. I saw Nike too. Microsoft is one of my most recent purchases. So here is actually my most recent purchases in order. I bought Uber, Microsoft, Ouster the same day. We bought them on 3/27, which is 20 days ago. So yeah, check this out. Microsoft right here. Here's why, if you're a shareholder, you don't sell this one either, because it's just going to continue to climb higher. And this is the number one software play, the number two cloud play, and potentially the number one AI play. And that's why this is like such a quality buy. So if you didn't know, Microsoft literally owns 28% of OpenAI. So if you want exposure to OpenAI, you can just buy Microsoft, who owns 28% of it. They're up over 18x on their investment. They also are the number one software play. Think of all their software products like Excel, spreadsheet, Word, PowerPoint. That business does over 120 billion of annual revenue. That's one of the reasons why they were falling so much from their all-time high. It's because they're a big software name, but I don't see their software getting replaced by AI. And if AI does replace software, they're hedged as the biggest owner of OpenAI. And they're also the number two cloud play. So if AI gets crazy big, they're saying they're going to need a lot of cloud compute. Like AWS is such in demand. They're the number one market share. Well, Azure Cloud is the number two market share. And this does over 100 billion of annual revenue for them as well. So I just can't believe how quality Microsoft is. I never sell this name. They have a better credit rating than the US government. You get 1% of your money back in a dividend every year, a 24 to forward PE. So you only trade at 24 times next year's net income. That, like, for the Magnificent Seven, Microsoft, that's so fair. They have a bunch of subscribers. They just rose prices on their Office 365 products. So yeah. Microsoft raises their Microsoft Surface product line prices raises prices significantly due to the memory chip shortage. So if you look at like Micron, SanDisk right now, the memory shortage is causing Apple and Microsoft and Sony PlayStation and Nintendo Switch to raise prices. You know, the memory shortage is crazy. If you just look at like Micron right now, SanDisk. I just had to buy a SanDisk external hard drive. That sucker was expensive. So, yeah. Next up, let's do HCA Healthcare. What's up, Tommy? I forgot to get to that one, or TMB. Watch out for that guy in chat there. Hold on. I'll get him banned. Yeah, hey, by the way, I sell nothing. I have no course, book, WhatsApp. I'll never follow you, DM you. I literally sell nothing. I don't coach. I'm just on here to give my opinion. None of this is financial advice or anything like that. So here's the next stock I wanted to go over. It's one that I do own in my Roth IRA. It's my favorite healthcare play, and they're my largest holding in my Roth IRA. This is HCA Healthcare at the very top. I got 5 shares. They're the number one hospital group. So if you want to, like, it's just like a safe industry. Hospitals, they're always in demand, and you get a good dividend. You get a 0.6% dividend, but notice the payout ratio for that dividend. They only pay out 10% of their net income for that. So there's so much future room for them to raise their dividend. And here's the bottom line. And the forward PE. This company only trades at 16 times next year's net income. So that's a cheap valuation. It's another one that the valuation can easily stretch higher. And here's why I think that. And also they've been crushing on expectations. The orange line's what the analysts predict every quarter them to report in net income. And notice the past 3 quarters in a row, they beat on net income every quarter. They're like per person admission prices up at the hospital. So anyway, here's their bottom line, their net income after tax. They're making on average like $2 billion of net income a quarter. And what are they doing with $2 billion of after-tax net income a quarter? Well, again, they pay a dividend. That dividend only cost $162 million. How did the cost of the dividend go down from 180 million to 160? That's because of my favorite part about this stock is the share buybacks. They buy back over look at the buybacks over time. They're buying back over 2 billion of their stock every single quarter. And I was looking into this. Basically, they can take out debt to buy back their own stock that yields them a stream of over 10%, and they can take out debt for like 4%. So they literally just pocket a 6% instant return by doing this. And it's so accretive for the shareholder. So look what that does. So the net income is up by 28%, but the net income per share is up by 44. How did the net income per share grow so much higher? Again, it's because they bought back so much of their own stock. They've bought back over 10% of all the company just in 1 year. After they bought back 7%, after they bought back 6%. So they are just a beast. Great, never sell healthcare stock. And if you're just looking for a quality, like AI-proof sector, hospitals, there you go. Hey, what's up, Matt? Good to see you. Hello from Texas. What's up, Debbie? Top five things to buy if a crash is coming. Well, if a crash is coming, you want to buy bonds, TLT. This is the cool part. A lot of people, like right now, there's something called a money market fund where you can basically keep your earnings in a 3.35% yield. You basically have a money market fund. Well, basically, a money market fund just buys treasury bonds, and basically you can buy the treasury bond yourself. So basically, if you buy TLT, which is the US 20-year treasury bond, you can lock in your yield right now. You buy this right now, you're getting, what's the yield? 4.4% of your money back, but you also capture the stock price appreciation of the bond. Remember, last time, this is literally inverse. Whenever Feds cut rates, this was 2020 when rates were zero, this was $166. So if rates are ever at zero again in your life, if rates are ever at zero, this sucker is going to double. So this is a way where basically you can get your 4% yield and also capture the stock price appreciation of the bond. It's better than a money market fund, I think, just buy TLT. But also there's gold, IAU, it's just gold, commodity of gold in an ETF. And it's arguably actually better to buy the ETF of gold over buying physical gold, especially in smaller quantities, because you're paying that spot fee when you buy it and sell it. And you also, if you buy a huge amount of it, you're paying to store it somewhere, and the fees are cheaper and it's more liquid to just buy the ETF, IAU or IAUM. What stock were you just talking about? Oh yeah, that's TLT. That's just the US 20-year treasury bond. Basically, it just does what rates do. And again, it's done so bad because we're not expecting rate cuts for another 8 months. But again, this was when rates were zero. If rates are ever at zero again, this is going back to 150, and you get the yield as well. So I love TLT. Basically, a TLT proxy is just REITs. REITs kind of move with them. McDonald's is almost a pseudo play on that as well. So anyway, yeah, let's go back to stocks though. Ooh, SoFi. This is a growth company. A lot of people think SoFi is a meme stock. Okay, hear me out. Here's why I think this one will impress you. This is no meme. This is a real growth bank right here. They got their own banking charter through a loophole. It was pretty crazy. If you're a shareholder of SoFi, like I am a shareholder, not financial advice. I'm kind of biased here, but the metric you want to look at is their financial services. This is the metric that is blown away all analyst expectations. No analyst expected this sort of growth. Look at these year-over-year growth rates in the middle. No analyst expected it to CAGR at 70 and 100% every quarter. The revenue's up 78, after grew 85, after grew 141, after grew 290. That is insane. And that beat all analyst expectations. Here are the analyst expectations. It's that orange line. And notice every quarter they beat on net income, and the future projections are super high. They're literally going to be making 200 mil of net income in 2 quarters. And that's why I think people are really starting to take SoFi seriously. The revenue just hits a new record every quarter, so they really are growthy. And it's not just revenue that's growing, but real bottom line after-tax net income that's going to go to 200 mil, which means a 20% net margin. So all that being said, SoFi, since they're a growth company, you don't want to really value them off current net income. You really want to value them off next year's net income. And SoFi trades right now at 50 times net income, but only 29 times next year's net income, making it a lot more attractive. It's certainly not if you wanted 5% of your portfolio in SoFi, you wouldn't make it 5% of your portfolio today, but maybe you'd nibble and make it a small little percent, because I regret every share I've ever sold of SoFi. I still got 24 shares left, but it's a cool growth company that I approve. I do own that one. It's one you want as a small position, not like some crazy meaningful size position, but I believe in their growth story. I love they're already profitable. There's so many stocks out there that are just junk, they diluting you, but not SoFi. SoFi is a different one. Make sure to drop a like. Hey, thanks, Plasma. I appreciate that. Okay. Thoughts on INFQ. They are NVIDIA's #1 quantum computing pick or something. Okay, let's check it out. So there are three. I know Quantum's kind of popular right now. Then we'll look at Shopify. I love Shopify. That's a big Kathy Wood stock. We'll do that one too. And what's up is Lopez. We'll do JBL too. Sorry if I'm missing out on some stocks. There's so many stocks today. I appreciate everyone that's on the stream. I stream every Sunday this exact same time. If you want to hit the follow button, I try and stream every day. So and I sell nothing. So here's a Quantum name, a $3.7 billion market cap. So do they have revenue right now? Okay, so there is no financials we can look at here. So they don't sell anything right now is what I'm assuming. Where are they headquartered? This is really odd. Okay, so they're headquartered in the US. I wish I could give you thoughts on this company, but this is really weird. I don't see many companies like this where we literally just don't get their data. Yeah, I'd be real careful with this one, or I wish I could just give you more thoughts, but my apologies on that one. Here's one I think you'll really like, though. This is actually in the Kathy Wood portfolio, right? Let's actually go find that. Let's verify. So here's Kathy Wood's portfolio. Yeah, she got, AMD. AMD's been on fire. Anyone seen AMD? They just hit an all-time high. But another one of her big holdings is Shopify. I'm a real big fan of Shopify. I used to have a Shopify store. So every Mr. Beast video is sponsored by Shopify. But basically, I used to have a Shopify store. Even if you pay for their highest tier subscription like I did, you still have to pay them 0.25% of every sale. It's basically a royalty. They're collecting royalties on every sale. But anyway, here's why I love Shopify. Like, this is impressive. Like, you got to hand it to Shopify. Literally every quarter for just all of history, the revenue just hits a record. Like the organic, like this isn't inorganic. Like they didn't acquire a company to get this. This is all organic revenue growth. Shopify's revenue is up 30, after grew 31, after grew 24. Like if we just zoom out, revenue basically hits a record every quarter. And it's not just the revenue, but also the profits. They're basically net income. This quarter specifically was the most profitable quarter they've ever had, 745 mil. Yeah, if we zoom out, it literally by far the most profitable, highest revenue quarter, highest profitable quarter. And same with FCF, which is free cash flow. Jeez, record free cash flow of 700 mil. So I'm a big fan of Shopify. I think they're Canada's biggest market cap. They're super expensive though. That's the tough part. If you look at that forward PE, they traded 88 times next year's net income, which is really expensive, but they deserve it for the growth that they have and this fortress balance sheet. It takes so much risk off the table when you literally have no debt. So they're debt free. How much cash they got? $6 billion of cash and no debt. So pretty cool. Yeah, they're actually headquartered in Canada. Pretty cool. But we were looking in US dollars. We converted it. But yeah, I'm a big fan of that one. How can you check out that portfolio? Yeah, it's just on this brokerage I'm on. You can see all the portfolios. Like you can see what Nvidia owns. You can see the Nancy Pelosi's holdings and like Batch Trade follow them in. Like basically super investors, like anyone with over a net worth of over 100 million have to by law disclose all their trades. So all these trades are all publicly disclosed. So like, and what's cool about this brokerage, you can like batch follow them into it. Anyway, if you'd like to get this brokerage I'm on, it's my favorite app to buy stocks. It's out. Someone asked, it's on my link tree there, the very first link. If you'd like to get this app I'm on, it's an affiliate link. It's actually completely free. But if you deposit $100, we'll both get like a free stock. So someone said thoughts on Netflix. Ooh, Netflix. Okay, so they just reported earnings. There were only two bad news things I could find. Let me see if they're down here. So basically, Netflix announces price increases. Let's see if we can find that. Yeah. No, I'm not seeing it right here, but basically they just rose prices on all their tiers. They rose prices on the ad tier and the normal tier, and they also lost 2% market share. So they basically are raising prices as they lost 2% market share. It's just not the best look, but Netflix is a decently good buy, and it's a great company. It's an easy business to understand. It's like a subscription model company. A lot of people, if they had to cancel a subscription, they would cancel Netflix last. Some people are like, hey, I know they're increasing the price by $2 a month, but they have pricing power. I'm willing to pay that. So check this out. Look at the forward multiple. They only trade at 28 times next year's net income. That's why I find Netflix pretty attractive. If we can get their data, they have 301 million premium subscribers, and they make on average $11.69 per month per paying membership, and they just rose prices by $2 a month. Assuming no subscriber churn, I mean, their ARPU should just continue to grow, or average revenue per user. So yeah, here's the bottom line. This was a technical one-time adjustment. They received a $2 billion termination fee for not acquiring Warner Bros. Discovery. They got a free $2 billion, which artificially made their net income look higher. But on average, they really are making like 2.8 billion of after-tax net income a quarter. Same with free cash flow. It also had the adjustment, but they're making like 2.5 billion of free cash flow every quarter. So they're a money printer. They print net income, free cash flow every quarter, and they're They're doing share buybacks. So I like Netflix. It's like what's that? Raises free cash flow on the termination fee. Yeah. So it's like fairly valued here. I wouldn't go crazy buying the stock yet, but it's not bad to like nibble on the stock. You know what I mean? I guess Morningstar says Netflix is overvalued. A maturing core U.S. subscriber base and the inability to sustain aggressive annual price hikes amidst intensifying competition warrant caution from investors. Well, there's the Morningstar analysis. But anyway, 28 forward PE isn't too shabby. All right. Could you ever Oracle? Yeah, what's up, Deborah? Let's do Oracle right here. This is a cloud play. So a lot of people, when they hear like the Azure cloud, the AWS, actually, here's how the market share. Number one market share is AWS, then Azure cloud, then Google cloud, then Oracle. So Oracle is the fourth largest market share, and they have a huge backlog. Looks like they're even partnering with AWS because they can't fulfill all their orders. But oh yeah, look at this. Oracle faces allegations of targeting employees with stock options. And basically, I guess they don't want, they know their stock's undervalued or something. But one cool thing about Oracle is their backlog. You will not believe this, but it's the third line here. Retaining performance obligation, which is contracted money owed to them once they can fulfill it. They are owed $553 billion. So that's what is crazy about the stock. They have a $500 billion backlog of orders. But the bad part is right now is a cash flow problem. To fulfill these orders, Oracle has to spend, and they just announced this, $20 billion a quarter for the next 4 quarters in a row. How are they going to afford $20 billion a quarter when they already are extremely leveraged, over $120 billion of debt? And look what that's doing to their free cash flow. They have to take out a bunch of debt right now to invest in all these assets. So the free cash flow is extremely negative every quarter. Negative 11 bill, negative 10 bill, and investors aren't too happy with them because they issued debt, and they were thinking they weren't going to issue more debt. Then they issued more debt, and the value of the previous debt fell 20% that day. So Oracle debt is trading at like junk bond, where you can get 8% yield buying Oracle debt, like crazy. I think it's kind of recovered now, but they also have a high dividend, which I don't love. They have a 1.2% dividend yield, but the valuation's fair. I mean, all that being said, it's overall more positive than bad. They have a 28 forward PE, so they trade at 28 times next year's net income, but that is the most expensive cloud play. Google's technically the same price. Microsoft Azure Cloud's cheaper. Amazon might be cheaper. So anyway, it's like a pure cloud play. It's like the pure cloud play. But I get my cloud exposure via, all the other Mag 7 via Microsoft Azure, AWS, and Google Cloud. So it's just I still see this one benefiting though. But it's kind of, the sad part is that one's probably my least favorite cloud play. Like before I buy that one, I'd probably rather buy AWS, then I'd buy Microsoft Azure Cloud, then Google Cloud, and then I'd probably buy Oracle. But that one's not too shabby. I mean, not too bad. Okay. What's next here? Chopper, what's up? Said Frog stock. Is that JFrog? Okay, this is a software name. She used to own this stock a long time ago. They have not done too well, actually. But let's check out how the revenue is growing still. That's what I would like to see. So I remember the revenue. Yeah, so they still keep that up. The revenue just hits a new record every quarter. So that's really impressive. Record revenue, 145 mil of revenue. But the bad part is they're still losing money. They were supposed to get profitable 2 years ago, but they're still losing money. But notice they're narrowing their losses. They only lost 15 mil, which is good. Good balance sheet too. So basically they have a lot of stock-based comp. So the free cash flow is really good, but this doesn't include the stock-based comp, which is included in GAAP net income. So they really are losing 15, 20 mil a quarter, but that's all right. They are, as long as they keep beating on these revenue expectations, I'm sure the stock will continue to do well. We just really want to see them narrow net income losses and get profitable soon. And they're probably falling right now because all of the software names are falling. You look at Microsoft, ServiceNow, Salesforce, Adobe, all the kind of software names are kind of struggling right now. But yeah, this one's a cooler, nichier software name. Anyway. That's JFrog right there. Hey, Tangrika said APLD. And hey, Junior, thanks for that gift there. I didn't even realize that. Hey, if you have a stock you may look at, let me know. So APLD, that's an NVIDIA holding. Or wait, actually, I think NVIDIA sold out of them. Hold up here. We go to here's NVIDIA's portfolio sold out. So look at this. In the most recent quarter, NVIDIA did just fully sell all their shares of APLD. If you didn't know, APLD is one of the biggest customers of NVIDIA. All this company does is own a bunch of NVIDIA chips. So they own a boatload of NVIDIA graphics cards. And right now, they are renting out the capacity of their graphics cards to cloud companies. So HPC and data center hosting, cloud service. So what does Morningstar say? They say APLD stock is overvalued. Although the company demonstrates a strong leadership and revenue driven by high-performance compute and AI demand, its severe lack of profitability, massive negative free cash flow, and extreme uncertainty rating warrant significant caution. So that's one thing that I say as well. These are like the parts of AI I don't want to own. I'd rather own the people selling NVIDIA chips at this one. Basically, chips are so expensive that instead of buying chips brand new, companies like Microsoft are saying, hey, let me rent out chips from a data center. So this company just owns a bunch of chips in a data center. That's not my favorite part of the whole AI trade, but I still think that this stock will do good through the end of the decade. But it's like, yeah, they just look at these net income. They lose a bunch of net income every quarter. The free cash flow, dang, negative 700 mil, 600 mil. So they're going through a lot of free cash flow. But they are beating on expectations. So that's the thing. I would be super careful with this one. I wouldn't buy it. I'd actually rather buy NVIDIA or something. I'd rather own the picks and shovels play. I'd rather own NVIDIA selling the chips or AMD selling the chips. But all these stocks have done really good. All that being said, I mean, the stocks still do good. Like if we look at Nebius, that does the same thing APLD does, Nebius is close to an all-time high. All right. Software scares me right now. I have some though. Yeah, software does scare me as well, but that's why I'm buying like only the most high quality software stocks in the dip. Here's specifically what I just bought. I guess Uber isn't exactly pure software, but I bought Uber for the first time 2 weeks ago, Microsoft for the first time ever 2 weeks ago, and also AppLovin. AppLovin, I actually almost want to cover this one if anyone's interested. When I bought them, they were down bad from their all-time high. They went from 740 all the way down to 340. And that's where I bought them at 380. AppLovin is one of my favorite advertising software stocks right here. But a lot of software has kind of had a decent rebound. Salesforce, I saw Emperor Penguin said, I bought Salesforce and I cooked. Let's do Salesforce. I do like them. They own Slack. That's a super popular company using like over half the S&P 500. Amazon uses them for their employee management. So anyway, Salesforce stock, unfortunately, like most software has been struggling. Salesforce is flat from basically 7 years ago. Salesforce is the same price as they were back in 2019. So dang. But here's how diversified that they are. They're in services, sales, and here's their Slack business. This has really been picking up the slack, pun intended. But yeah, look at the year-over-year growth rate is what I mean. This is the highest growth rate on the entire screen. It's up 38%, after grew 15, after grew 10. So the growth rate is growing this quarter specifically. So that's good news to see. But all their other businesses are growing low single digits. So services actually this one's good. That one's up 8%. Sales are up 9%. Slack is up 38%. Integration is up 3%. Marketing is up 1%. And platform is negative 3%. But anyway, if we combine all those businesses together, top line revenue grew 12%. So the revenue grew 12% and the net income grew by 13%. They're printing money now. They're the most profitable they've ever been. It used to be a tough buyback here. They were losing money every quarter, but now they're the most consistently profitable they've ever been, making call it $2 billion of after-tax net income a quarter. You get a 1% dividend. They do massive share buybacks. Oh, and they have insane free cash flow, like insane free cash flow. They're making, what's that? 10, 7. So they're making like 15 or 14 billion of free cash flow a year. It's just incredible. And then, then you add the stock-based comp, and then they're making around $7.5 billion of after-tax net income a year. So they're trading. So they're making $7.5 billion net income a year. They only trade at 19 times next year's net income. And again, one of the reasons why Salesforce is falling is you got to weigh the risk. Like it's really a sentiment on, do you think AI is going to replace this? Can people really just Claude code, ChatGPT code their whole employee management software? I mean, I don't think that's happening anytime soon, but it could be a risk hurting their pricing power or something like that. What is free cash flow? Yeah, basically free cash flow, it's one of the metrics. So it doesn't include certain things, but it's the cash flow that is basically added onto the balance sheet after. We can click on a company like, I don't know, who should we click on? Tesla right here. What's Tesla's free cash flow? Or actually a software name is a good example of this. Like, what's a random freaking software name? Zscaler. Okay, so the free cash flow doesn't include stock-based comp and non-cash expenses. So basically, GAAP net income includes non-cash expenses. So basically, companies that pay their employee with stock, it's not included in free cash flow because it's a non-cash expense. So basically, free cash flow doesn't include the non-cash expenses and GAAP net income does. And that's why it's always important to look at the GAAP net income, because at first glance you can say like, hey, this company made 169 mil of free cash flow this quarter. Oh, but they paid $200 million worth of stock to their employees. So on a GAAP net income, they actually lost 34 mil, because if they didn't pay them with stock, they would have had to pay them with cash. So, but also free cash flow is like the cash flow they make after they pay all the interest on their debt and stuff. I've done a deep dive on all this right here on my YouTube. What platform are you using? Yeah, hey, this is actually a brokerage where you buy stocks. And if you'd like to get this platform, my favorite one, I have an affiliate link. It's on my link tree in my bio. It's the very first link on my link tree. So yeah, if you'd like to support me, check it out. Oh yeah, someone said, what's this brokerage on the YouTube? Yeah, hey, if you're on the YouTube stream, it's actually the first link in the description. It's called Moomoo. Yeah, if you'd like to use my affiliate link, it's the first link in my link tree. If you'd like to use my affiliate link. All right, so let's keep going here. Look at some more stocks. Plasma said TEL. What's TEL? Let's do it. Hey, TE connectivity. Yeah, hey, I saw that one on the YouTube stream, and I see it on TikTok. What's up, dude? The issue with SanDisk, yeah, the 2028 numbers. We'll do that one too. Then we'll do IBM, XTIA, Coke. Oh yeah, hey, Tomboy, so sorry. Remind me to do AppLovin and Coca-Cola Consolidated. I'm so behind on the chat here. I'm so sorry. So let me do TEL or TE connectivity right here. So this stock is at an all-time high. I believe they're doing some optical fibers for data centers right now, or that's one of the tailwinds. So yeah, look at that forward multiple. So right now they trade at 35 times net income, but they only trade at 22 times next year's net income. That implies to me that this stock will probably just continue to hit newer and newer all-time highs. So they're in transportation solutions and industrial solutions. Maybe they're industrial solutions. Yeah, just as I thought, their industrial solutions is really booming, probably from data centers. You know, it's up 40%. Last quarter it grew 97 and then 30%. So I'm almost guaranteeing that their industrial business is booming from data centers. And they've been crushing expectations. Yeah, the orange line's what the analysts expect them to report. And notice every quarter they beat on revenue, beat on net income. Oh, geez, they're printing net income, 750 mil. So, interesting. And you get a 1.1% dividend yield. I can see why this stock has done so well. And it only still trades at 22 times next year's net income. I would expect that one to just continue to climb higher. So, yeah, let me do Coca-Cola Consolidated. Or let me do AppLovin, actually. Remind me to get to Coca-Cola Consolidated there, Tom. My bad there. Let me do this one first, though. AppLovin is one of the software stocks I just bought for the first time ever. So out of all the software stocks to buy on the dip, I really think this is one of the best ones to buy. And unfortunately, it has rallied 20% the past week, but I'd put it on the watch list in case software does start to fall again. This is definitely one of the more higher quality software stocks to buy on the dip, because mainly this is an advertising company and they print money, their margins. It's better margins than NVIDIA. You won't believe it. Here's what impressed me. I'm not just recommending this stock because they're on a dip. I'm recommending them because of their quality financials. You won't believe this. Check this out. The revenue, the sales this quarter was 1.66 billion, up 65%. But on this 1.66 billion of revenue, they kept an after-tax net income. After paying taxes, they kept on this 1.66 billion of revenue, 1.1 billion of net income. That's after they paid 180 million of taxes. So they literally have a 66.5% net margin. So you go spend $100 on one of their ads, they keep after tax $66.50. So this is a net margin expansion play. They're literally a money printer. They're basically collecting royalties. So they have oh my goodness. So the free cash flow is even better. So if you go spend $100 on this company, $66 of that goes to net income and $70 of that goes to free cash flow for the company. And it's not like the analysts see the growth slowing down. The revenue is supposed to hit 1.9 billion in 2 quarters. And on that 1.9 bill, they're going to make 1.26 billion in net income. So that's the crazy part. So they only trade at 30 times next year's net income. Because they're growing so fast, you really want to value them off next year's net income, not current net income. So yeah, I can't believe it. The net income just hits a new record literally every quarter, and it's just going to continue to climb higher. Same with free cash flow, 1.3 billion free cash flow, 1.1 billion net income after tax. So this is why I love AppLovin. And I am biased because I just bought them. So Morningstar says they're undervalued. Robust performance of AI-driven Axon advertising, successful expansion beyond gaming will drive long-term value growth. So anyway, that's a great software name with incredible margins. Like, stay away from like the software names that are losing money. Like, pick a one. Like, if you're going to buy a software stock on a dip, buy a software stock on a dip that's quality like this one that has 60% net income margins and 70% free cash flow to sales margins. I mean, it's just ridiculous. So Let's do next. Oh my gosh, I'm like so behind here. I'm so sorry to everyone. I have a whole list of stocks. Let me do Coca-Cola, then we'll do IBM, then XTIA, then we'll just find out some more here. Hey, user, remind me to get to Grab and Palantir. Oh my goodness, these are all great suggestions. So here's Coca-Cola Consolidated. This is not the main Coca-Cola company you've heard of before. This is the Coca-Cola Bottler. So this is like more of a staple than a consumer discretionary. So all they do is bottle for Coca-Cola. So they are the largest bottler for Coca-Cola and Monster in the US. So if we just zoom out, the revenue kind of just grows like single digits. But recently they've just had a lot of pricing power. So here's the profits over time. In 2018, they were making 12 mil a quarter, not much. But now they're making like 250 mil a quarter. It's really impressive. And with this 250 mil a quarter, the main way they return money to you is share buybacks. The most incredible thing, right here at $127 a share, you're not going to believe this, they bought back 22% of all the shares that exist at $127 a share. So the main reason the stock has gone up so much is because of the share buybacks that they've done and the pricing power of the products that they've had. They've been able to successfully keep on raising prices. It's like a Christian value-based company. I love the mission here. There's no earnings calls. The owner, Jay Harrison III, I've met him. I've shaken his hand. He's a great guy. He owns 80% of the voting rights, and that's how he's able to keep the company Christian values. There's like a chaplain in all their bottling facilities. Anyway, great company. You get a dividend too. You get a 0.5% dividend. Look how they raised the dividend, safe payout ratio. So anyway, that's what I own in my buy and never sell portfolio. I literally plan to never sell this stock. I got 27 shares and I bought them exactly a year ago. And somehow already in a year, we're up 68%. Or what was 67? 6-7%. Hey, not too shabby. So what's a very safe stock? Ooh, a good question. There's a lot. Actually, I have a watch list right here, like safe, never sells. Oh, this has been narrowed down, but like a waste management, kind of an AI-proof company that has great returns. Boring waste management, sometimes it's the really boring stocks that give great returns. Like waste management's done great. Walmart, HCA Healthcare, McDonald's. I love McDonald's stock. That's actually another one of my largest holdings. I'll show you that. McDonald's is actually my second largest holding. I got $5,600 in there because McDonald's is really a real estate and royalty company. They collect a 4% royalty on every sale at a franchise, and they collect rent from every franchise. So literally the business model is McDonald's collects rent and royalties. Pretty crazy. So let's do Palantir, and then we'll do XTIA and IBM and SMD. So we might have to skip some because I'm so behind in the chat, and I'm just like, I apologize. And hey, Clay, thanks for that gift. I appreciate that. So here's Palantir, a great defensive name. So if war starts to escalate again, this could be a really nice hedge in that environment. So Palantir selected by FAA to complete air-based air traffic management tool. Department of Defense requires Palantir to remove Anthropic's Claude code. Oh, wow. Yeah, I guess the government's beefing with Anthropic. But anyway, here's why I love Palantir. 55% of the revenue comes from the government, the military, all the police stations. This revenue is so growthy. It's up 60% year over year. After grew 40, after grew 10. So literally the growth rate is growing. This is why the stock has done so well. It's up 60% year over year. And not just the government revenue, but also the S&P 500 customers, the commercial side of business, which is up 82%. After grew 31, after grew 32, after grew 17. So no wonder the stock is trading so expensive. And here's the net income projections. They crush net income projections every quarter. Analysts expected 460. They did 608. And last quarter, they beat by 100% on net income. So that's why people are really loving Palantir. They print net income. The net income literally just hits a new record every quarter. Same with free cash flow. That's what FCF stands for. Record free cash flow this quarter, record net income this quarter, in a monster balance sheet. They have no debt. They are debt-free, over $7.2 billion of cash, and that cash just sits there earning interest. So, when you owe no one any money, whenever you make this net income or free cash flow, you just add to your cash pile. So anyway, I have no complaints around Palantir. The only sad part is they're expensive. If we go to their valuation right here, they trade at 120 times next year's net income. So, they currently trade at 230 times net income, so it's a nice cutting in half in 1 year, but it's still too expensive for me to pay. But a company like this certainly deserves a super expensive multiple. And Palantir is one of my biggest regrets ever. Y'all want to see something super sad? Here's Palantir Technologies at the top. It's $150 a share. Look where I sold my shares. Oh, I sold my shares at $8.29 a share. So hit the like button for that RIP. Sold it at $8 and it's 150. I'd be up like 1,500%. But that's when that was like when I turned 18. All right, let's keep going here. IBM, this is a great dividend stock right here. So if you buy IBM, oh, and they're a nice quantum play as well. Or let's see if there's any specific news right here. IBM settles DOJ investigation. Okay, whatever. What is this right here? All right, well, let's just go look at their actual financials here. So they're about to report earnings. Wait, they report earnings, in the 22nd. So in literally 3 days, get ready. So if you buy the stock now, it's kind of like betting into earnings. They report earnings in 3 days. And whenever they report earnings, that's always a big catalyst. It always moves the stock up or down a bunch, but they're pretty inexpensive. Hey, what's up, Trapper? Good to see you, man. And per sharp. Dude, thanks for that gift there. So, yeah, look at the PE ratio. They only trade at 22 times net income. But one of the reasons I think IBM has fallen from its peak is because mostly they're a software revenue, or half their revenue is their software business. And if you look at any software company like Microsoft, Adobe, Salesforce, a lot of software is sucking right now. They're also in consulting and infrastructure. How's the infrastructure growing? That's up 20% year over year. Consulting is up 3%, and software is up 13%. Okay. So not too bad. And here's their bottom line right here. So they're making a net income every quarter. Yeah, a couple billion net income, easily over like 2 billion in net income a quarter if we average it out. But the best part is if you buy the stock right now, it's one of the highest yielding stocks or higher yielding software names, 2.8% dividend. And it really does have a safe 60% payout ratio. Here's the net income projections. They're supposed to make 1.3 and then 2.5 billion net income. Let's see how much the dividend cost exactly for the fun of it. It's in their cash flow statement. So every quarter, no matter what, they have to pay out 1.57 billion in net income a quarter. And as we can see, they make over 1.57 bill every quarter. So not too shabby. I know they're also getting into quantum. So XTIA, what was this one again? XTI Aerospace. Okay, so I'm a big fan of aerospace and defense stocks, but I would be super careful with this one. Looks like the stock has done a ton of reverse splits and it's at an all-time low. Yeah, look at this market cap. It's just hard to trust these companies. If you look in the top right, they're only worth $88 million. So if you wanted to, you could buy the whole company for $88 million. Let's say you do it. You pay $88 million and buy the company. Well, here's what you bought. You bought an asset that lost you $21 million in one quarter, then 13 mil, then 20 mil, then 12 mil, then 13 mil. So you've already in just 1 year, you've almost lost your original investment back. So cumulative, this company just burned a bunch of net income and it looks okay. So they're getting their first ever sort of revenue. That's at least good. So they did 19 mil of revenue. All the quarters before today, it's basically been no revenue. So basically you're buying this company as they're converting from a company doing a little amount of revenue to a lot. I guess analysts are projecting, well, okay, wow. So honestly, this is what you're going to want to watch. Revenue is supposed to have 41 mil, but there's just such bankruptcy risk here. It's actually really scary. So that's why I think the stock has done so terrible and is only worth 80 mil. It's because there is some real bankruptcy risk there. And they can't really dilute shares while the stock's at all-time low. Safety is greater with an ETF. You get diversification. I agree. I love ETFs. Have that as the backbone of your portfolio. You can't go. Most retail investors, most hedge funds can't outperform, the QQQ and the S&P 500. So if you can't beat it, why not own some of it? Yeah, hey, I saw you asking this one for a while. My bad for missing it. There's just so many companies I want to get to. I apologize if I'm missing on some of these. What's up, Paul and Mr. L, John, Brad, Sheldon, Debbie? Good to see you on. Andre. So here's Grab Holdings. This is international Uber. So this company does exactly what Uber does, ride sharing, but they do it internationally. So check out where this company's revenue comes from. It comes from Malaysia, Singapore, Indonesia, Philippines, Thailand. So all these international markets. So basically it's like international Uber. And the really cool part is that Uber just backed this company. Uber is the largest shareholder. They own 13% of all the company shares. So basically 13% of all the revenue goes back to Uber. But basically this was just super genius by Uber because Uber's having a tough time expanding internationally, getting into these markets. So if they're like, hey, we can't get into the markets, why not just buy the number one player, which is Grab? So anyway, that's what's cool about them. And they're also just now getting profitable. They're the most profitable they've ever been. A year ago was a tough buy. The business was losing 100 mil a quarter. Well, now they're making 100 mil a quarter. And at this growth rate, what's it going to be the same time next year? So I'm a big fan of Grab. Good balance sheet as well. So yeah, you're buying them as they're getting profitable. Uber backs them. Morningstar says they're undervalued. An expanding network effect in its core mobility segment and reaccelerating gross merchandise volume in the delivery business will drive long-term value growth. And they're profitable already. So I'm a big fan of that one for sure. Um, what's next here? Um, Paul, oh wait, SMD. Let me do SMD here. Please remind me. Oh wait, I looked up SMD. Let me know if you're talking about this Canadian stock, Strategic Metals. It's a micro cap worth 35 million. So actually, I can't find SMD. I did look at that one. Um, but Paul said SanDisk, Hood. Let's do SanDisk or Robinhood. Let's do SanDisk because this one is the memory shortage company. So memory prices are through the roof right now, and it's literally causing Microsoft Surface to raise prices, Apple to raise prices on the iPhone, Sony PlayStation's raising prices, and Nintendo Switch margins are collapsing because of this, and they're raising prices as well. So basically, this is your play on the memory shortage. And check out the future projections. The reason the stock is at an all-time high right now is because the future projections. You won't believe how good they are. If we scroll down to the net income projections, next quarter, they're supposed to do $2.1 billion and then 3.3 billion of real after-tax net income the quarter after. So basically, the company's going from like a business that used to lose money every quarter, like barely make any net income, to now going to be making like 3 billion in net income a quarter. So if we look at the forward PE, so since there's so much growth coming in through this next year, we want to value them off next year's net income. They only trade at 9.8 times next year's net income. That's why I feel like this one could still stretch up higher. Like low key, if I was a shareholder of SanDisk, I really wouldn't trim or sell. I kind of expect this one to continue to climb higher. I feel like it could stretch up to like a forward PE of a 12. But there is one thing to note, like potentially 2027, 2028, that could be peak ever earnings because they just sell a commodity, RAM, storage, SSDs, all that. Actually, I just bought a SanDisk external hard drive on Amazon. Sucker was mad expensive from when I bought the same one like 7 years ago. But basically, it's just I would expect this one to continue to climb higher, but you really want to think about the long term. It's like a supply chain thesis. If the supply chain just fixes itself and the prices go down, then that will really put a strain on them. But for the foreseeable future, because they're booked down to like 2027, like it's great. I'm going to start a new position in Visa. Oh, remember to get the TER Teradyne. That's a cool robotics stock right there. I always buy, never stop. If you keep buying, yeah, that's a good thing. Dollar cost average. And Andre said, any currency you recommend to invest in? I don't recommend any currency. That's Forex trading, just trading the differences of like currencies, right? But currencies historically always go down. Every currency ever goes down by like 5 to 10% a year. So the best hedge to not lose to inflation is always for history just been owning stuff, owning stocks, owning real estate. But yeah, I'm a big fan of stocks. So here's Visa. This is a phenomenal stock to buy, not financial advice. Those small, every time you swipe your credit card, those small little microtransaction fees that are slowly bankrupting us are making Visa a boatload of money. And Visa only trades at 24 times next year's net income. Here's the thesis here. If you use a Visa card, why not own the stock? I'm always a fan of own what you use. If you pay for Netflix, own Netflix. If you like Google and YouTube, if you like Meta, Instagram. So anyway, here's Visa. They did $10 billion in revenue. Check this out. On this $10 billion of revenue, they kept an after-tax net income $5.85 billion. So Visa literally just collects royalties. Basically, every time you swipe your thing, they basically collect a 50% net margin fee. So they're collecting an after-tax net income every quarter, $5 billion in net income. So what is Visa doing with $5 billion of after-tax net income a quarter? Well, they return some of that to you via a hold on, watch out for that guy in chat there. Try not to, by the way, I sell nothing. I have no course book. I'll never follow you, DM you. Watch out for people impersonating me. But anyway, speaking of Visa, they pay out of the $5 billion, they only pay $1.3 billion in dividends a quarter. So they have so much room to raise their dividend in the future. But the number one way they return money to you as a shareholder is via share buybacks. They buy back at the top 4 to 5 billion of their shares. Just for all of history, they've just done this. They're buying back billions of their stock a quarter, and that does wonders for the share price. Whenever they buy back their own shares, it gives you more ownership in the company, makes the EPS go up, makes the dividend cost less, and basically just forces the stock to go higher. So the net income grew by 14, but the net income per share grew by 17.4 because the share part of the ratio went down. That's what's so cool. So anyway, yeah, you get a near 1% dividend. They raise it faster than inflation every year. They're buying back 4% of the shares a year, plus the half a percent dividend. In my opinion, to buy the stock now, you get S&P 500 type returns, potentially 8 to 10% of your money back a year with Visa, especially at a 23 forward PE. It's very fair. I like your portfolio. Thanks for sharing. Yeah, hey, I'm about to do a huge portfolio update. I have multiple portfolios here. I have my dividend-only Robinhood portfolio, which only holds dividend stocks. I got Google, McDonald's, Meta, United Rentals, Constellation Energy, some popular names in there. And then we have a Webull portfolio as well, kind of growthy. I got like AMD, Microsoft, Southern Company, Uber, Progressive, Reddit, Clear Secure, AppLovin, Sprouts Farmers Market, SoFi, Robinhood. So yeah, that's my portfolio. Yeah, Visa and MasterCard are very similar. And hey, what's up, The Burge? So let's see what's next here. What are y'all asking? I sold all my MicroStrategy and bought Bitcoin when it was at its low. Hey, nice. All right. Next up. Oh, I see NU. Hey, Clay. What's up, Clay? Hey, I actually really like NU. That is a Bitcoin, or it's actually a crypto bank out of Brazil. And you won't believe how good this stock is. If you want exposure to crypto, this is a stock you can buy to get exposure to crypto that has real good fundamentals. It's almost like buying a cryptocurrency, but this is like the best cryptocurrency you could ever buy. So anyway, here's where the revenue comes from though. So 91% of the revenue comes from Brazil, and that's where crypto for actual transactional purposes are really popular because the currency down there isn't so good. So it's like actually crypto for transactional is way more popular in like these other countries like Brazil. So anyway, if we go to the revenue this quarter was 4.6 billion, up 56%. And that's organic. Like they didn't acquire a company to get that. It's up 56% after grew 25. If we just zoom out, the revenue hits a new record every quarter. In 2020, they were doing 200 mil. Now it's 4.69 billion. And the most impressive part is on this 4.69 billion of revenue, they kept in net income $900 million. Like they literally, this is in US dollars as well. They kept $1 billion. Even though they're not headquartered in the US, this is in US dollars. They kept basically $1 billion in net income. So if we look at the valuation on this company, and again, one of the reasons why the valuation I think is this low is because their revenue comes from Brazil and like headquartered there, and that just demands a lower multiple. But it's super fair. This was a US company. They're actually applying for a US banking charter right now, but they only trade at 18 times next year's net income. So that's such a dog cheap valuation. Morningstar says the price is undervalued. Its dramatic cost advantage, driven by a fully digital banking model, combined with rapid and successful expansion into underbanked markets like Mexico and Colombia, will drive long-term value growth. So it's a bank with exposure to crypto that prints money. What's the net margin on this? 19% net margin, but net income just hits a new record every quarter. Really impressive on NU. Yeah, Clay, that NU's coming to America. Yeah, you're right. You look at a penny stock, RZLV. Yeah, I'd be careful with that one. Let's actually check it out. I haven't looked at them. Oh, and then I saw PL. That's Planet Labs. That's a huge Google partner. Google's the largest shareholder of that one. But yeah, this is Resolve AI. If you look at the top right, they're only worth $900 million. Now, I don't know what kind of AI this company is. Are they doing like a language model? Or are they like trying to compete with like Gemini and ChatGPT? Or like what kind of AI are they getting into? Let's see. So they're a software industry. They're headquartered in London. So they're UK. Is where they're headquartered in. So mobile commerce industry, cutting edge engagement. Well, let's just go to their website. Maybe we can get a better idea. AI that transforms commerce from search to checkout. So they're actually partnered with Microsoft, Google. So, here's, I guess, their proposal. So if you use their software, you'll get plus 8% average order value, plus 17% add to cart, minus 5% wait time. So basically, if you're an e-commerce site, you can use their software. So let's see what their revenue is. So for the actually, this is in US dollars as well. For the full year 2025, they did 46 million in revenue, but they did lose 100 million on that. But we definitely want to see them narrow losses. But it is impressive, just this massive top line growth. Let's see what the future is. So they're expecting 60 and 76 million of revenue to come. So yeah, 900. So this is the one bad part. So look, they're worth 908 million. So the whole company's worth 908 million. And they just lost 101 million. And that's 10% of the entire company. And for the full year 2024, they lost 173 million, which is 17% of the whole market cap. So there's like a battle. We definitely want to see them narrow their losses really quick. I wonder what the short interest. So yeah, the short interest is going up. In 2025, it was only 0.4% of all the shares are being shorted. Now 13% of all the shares are being shorted. That short interest is just up and to the right. So there is some short, there is some big bear thesis on that company you definitely would want to keep in the back of your mind. So I would not have that one as like a meaningful size position. Jay says, Resolve is good. I had profit in this one. Are they going to go down afterward? Yeah, I don't know. They have really impressive revenue growth, and it looks like they have some good partnerships. Can I invest it in you on Robinhood? Well, let's see. They're headquartered in the Cayman Islands, so I don't know. Let's see. Yeah, in you. Yeah, you can. Actually, matter of fact, I think I owned this stock at one point. Dang, back in 2023. This is what I'm telling y'all. My biggest regrets in the market are selling out of great companies. Look, I used to own, well, it wasn't that much, but I sold my shares at $4 a share, sold my NU at $4 a share, and it's $15 a share. So I'd be up like 400%. Same like Palantir. So actually, that's why I made this portfolio right here. If you look at the top left, this is called my buy and never sell portfolio because I'm not going to allow myself to sell high quality companies. That's another one of my biggest regrets, like Robinhood, SoFi. I regret every freaking share I've ever sold of these. Like Robinhood, we only own 5 shares. Used to own 55 more shares. I sold it at $36 a share, these 55 shares, and it's $90 today. Sometimes your biggest regrets in the market won't be stocks you lose money on. It'll be like selling out of great companies. So, all right. Next up, I see GGG said, PBM. Do you own any stocks in the Visa sector besides SoFi? Not really, no. So PBM, actually, we're not going to cover this stock right here. We just don't cover these kind of stocks. I apologize. If you look in the top right, they're only worth $8 million. Like the whole company's only worth $8 million. They're at an all-time low. Like that, I just like to, hopefully people are aware of that. Because I promise you, when I first started invested, I didn't even look at market cap. I'm like, the chart's down, it's probably a good time to buy. Like, but when you start to know, like, okay, if I buy this stock now, do you realize that the whole company's worth $8 million and they lost in net income? You know, they have revenue. They lost 1.5 million in just the most recent quarter. They lost 1.5 million and they have no sales. So it's a revenue-less startup. They have no revenue. They just lost 1.5 mil, which is, 50% of the market cap. So there's definitely going bankrupt. Do not buy that one unless it's some short-term swing trade momentum, something. But yeah. Oh, hey, try not to spam there. Yeah, we'll get to Uber after this. Yeah, try not to spam there. I said I'd get to Planet Labs first. Let me do Planet Labs, then we'll get to Uber and some of these other names. Oh, Monkey D. Luffy, what's up? We'll do Viva, and we'll look at ARM. ARM is a really cool royalty, and Marvel as well. Yeah, actually, we'll do Marvel and Berkshire Hathaway. So here's Planet Labs. This is basically the satellite company helping out Google Maps. If we go to the shareholders down here, look at Alphabet owns Google. So Alphabet is basically the parent company of Google. But yeah, Google owns 9.3% of all the shares. So they're the largest shareholder. And check out the growth that they've experienced. Revenue's up 41% year over year this quarter. Last quarter's up 32, 20. So they're experiencing some nice growth. And if we actually... Let me zoom out on that trend. If we zoom out on this revenue right here, it kind of just hits a new record every quarter. So record revenue this quarter. And let me show you a little bit more about what they do. They have like active Pelican satellites in space right now. And basically they do high quality imagery. And they have a huge partnership with Google Maps. Basically, like 10 years ago, when you'd zoom in on place on the Google Maps satellite, it would look really terrible. But now it looks good, thanks to them. So yeah. Some satellite space play, and recently with the SpaceX IPO, these space stocks have been on fire. I mean, I certainly would not buy this stock at all-time highs, but I mean, dang, they have impressive revenue growth. But one other bad thing is they're not making any money yet. Dang, they're actually losing. They lost 150 mil, but really impressive numbers. What website is this? Yeah, hey, this is actually a brokerage where you buy stocks on. If you'd like to get this app I'm using, it's actually in my link tree, the very first link on my link tree. It's an affiliate link for this app. So if you deposit $100, we'll both get a free stock, but it's a completely free app, costs nothing, no monthly fees, no fee at all. You get a 3.35% APY on your idle cash, and you can, anyway, let me not promote that, but yeah, I have an affiliate. It's just called Moomoo. You can just type it into Google, but it's on my link tree in my bio called. So let's look next at MRVL. Oh, Berkshire Hathaway though. So Berkshire Hathaway, this is Warren Buffett's company. Warren Buffett did just step down, but this is an ETF in one. It's like an alternative to the S&P 500. Let's see. Berkshire Hathaway may have sold $15 billion in stock. Okay. Is there any other thing specific here? Okay. Well, anyway, this historically has outperformed the S&P. Like the S&P does 10% a year. Berkshire Hathaway has done like 12% a year or something. It has underperformed though. If you actually look at the S&P 500 right now, it's at a crazy all-time high. when this one is still like 20% off its all-time highs, but that wouldn't scare me out of them. I still really like Berkshire Hathaway, only at a 21 forward PE. So this is basically an asset manager. You know, they own Geico. Have you heard of Geico before? They literally own Geico. That does over $100 billion of annual revenue a year, just that. They own the McLane or Pilot gas stations. They own Dairy Queen. They own BNSF Railroad. They own 20% of Apple, like a bunch of UNA. Like, actually, let me show you the Berkshire Hathaway investments. So not only do they wholly own some companies, but they also individually own some stocks. Like they own Apple, American Express, Coca-Cola, Bank of America, Chevron, all these stocks here, Moody's, Google. So yeah, great way to get into the market. Diversifies you. Great S&P 500 alternative. So, okay. Oh yeah, okay, Marvel and then Uber. Yeah, hey, don't worry, we'll get to Uber. We already looked at them, so I'm trying not to. But anyway, I did just buy Uber for the first time. So here's Marvel Technology. They're getting orders, I think, from Google and Nvidia right now. I want to cover this real quick. This is really important. So, first set of news. Nvidia announces a $2 billion investment in Marvel Technology. So Nvidia just bought $2 billion of this company's shares, which is about probably around 2% of the company when they bought it. NVIDIA did this for AI infrastructure and optical interconnect development. Wow. Let's see. Is there Google? So look at this. Google is in talks with Marvel Technologies for custom TPU deployment and AI infrastructure. So this is your semiconductor picks and shovels play. Let's see. Is there any custom AI chips and optical connectivity will fuel long-term growth? Morningstar says the shares are currently fairly valued. But yeah, check out the profits right here. They're the most profitable they've ever been. If we zoom out, like a year ago, it was a tough buy when they were losing like $100 million a quarter back here. But now the business, they're the most profitable they've ever been. They made $413 million this quarter. That was the before tax. I'm looking at the before tax number because last quarter they had a one-time adjustment. It says they made $1.9 billion. They only made $367 million. The only reason it was $1.9 billion is because if you go to their cash from investing activities, they sold off one of their own assets. They sold off a lower margin segment of their business for $2.4 billion so that they had a realized gain. It artificially made their GAAP net income look higher. But anyway, point being, they really are this quarter the most profitable they've ever been. Highest margin, like gross margins are up, net margins are up. And look at the future projections. Revenue's up to the right. Revenue's going to go from $2 billion to $2.6. Net income's going from $190 to $390. So there's still going to be 100% EPS growth. And I bet that's not even pricing in this new NVIDIA deal and the Google TPU deal. So, and it's not just Marvel Technologies that's at an all-time high. Look at AMD. AMD's at an all-time high as well. Let's go. So not too shabby. Yeah, actually, it was like Anthropic. Yeah, Anthropic orders AMD chips as well. But anyway, Marvel's an alternative. So let's do Uber right here. Uber. Yeah, hey, all right, we're finally here. So Uber, I did just buy this one for the first time ever. Well, 2 weeks ago, I just bought Uber. So I'm actually really pleasantly surprised. I'm already up 12% and I literally just bought them. So Uber is one of the best stocks to buy on the dip. It's kind of hard to buy it after its 10% rally. But if software starts to fall again, and I get Uber's not exactly software. It's kind of discretionary and a travel play. But if Uber goes back to this $69 level, I'd put it on your watch list just in case it does. So here's what's so great about Uber. Here's their active users. And there's not just users, but these are monthly active consumers. They have 202 million monthly active consumers, up from 171 million. So not just people on the app, but people consuming their product went from 170 to 202. Like their main businesses are still booming. Mobility revenues up 19, after it grew 25, after it grew 33. But the main growth driver recently has been the delivery side. Uber Eats and actually B2B delivery, business to business delivery. This is up 30%, after it grew 21, after it grew 7. So the growth rate is literally growing on the delivery side of business to a record revenue on all segments. So no wonder the stock is doing so well. So if we zoom out, the revenue this quarter hit a record. So record revenue, and not just record revenue, but record profitability. This is the insane part. Like, this is why I'm not scared out of Uber. Like, they're saying, I guess, and robo-taxis are going to hurt Uber, but Uber just partnered with robo-taxi. I think it's the platform where you go to book an Uber or go to book an autonomous vehicle. That's where the money's made. So yeah, and Uber commits over $10 billion to autonomous vehicle fleet expansion technology. So they're going to oh wow, Uber acquires an additional 5% stake in Delivery Hero for $270 million. You know, Uber owns a bunch of Grab. Looks like they're buying. Ooh, this is sad. Look at this. So rising gasoline prices squeeze Uber and Lyft drivers' earnings by up to 25%. there any Uber and Lyft drivers in here? That's really rough. I mean, 25% of your margin is now gone just because of these rising gasoline prices. That sucks. But also because of rising gasoline prices, people are using and booking Ubers more and more, I heard. But anyway, the point being, I like this stock because record profits. This quarter was a record profitability quarter in net income and in free cash flow. So no wonder Uber is doing all these acquisitions. They just bought Delivery Hero. They also just acquired Spot Hero. They wholly bought, and that's an app I use. They bought Spot Hero, where you book parking spaces. Looks like they're buying Delivery Hero. They just bought Black Lane, which was a like limousine high. So anyway, I'm so bullish on Uber. They have no net debt. They're doing a ton of acquisitions, and I don't think they're going to get out innovated by robotaxis. I think they're going to benefit from robotaxis. Is this account legit? Yeah, hey, this is my only account. Jay, what's up? I sell nothing. I have no course book, WhatsApp. I'll never follow you, DM you. It's my only TikTok. Yeah, and I sell nothing. I have no course book. I don't coach, literally nothing. So yeah. Oh yeah, ARM. I'm so behind. I am so sorry to everyone if I'm missing your stocks here. Can you use Moomoo from a phone or do you need a laptop? No, I'm on my phone right now using it. Yeah, hey. Yeah, if you'd like to get Moomoo, it's in my link tree. First link there if you'd like to get this app I'm using. It's called Moomoo. I'm on a brokerage right now called Moomoo. If you'd like to get this app I'm on, it's free. If you'd like to use my affiliate link, it's in my link tree there, the first link. Hey, Plasma, thanks for all those gifts there. I really do appreciate that. I missed that. The corn and the freaking taco. Thanks for that. So here's ARM. This is a chip company. So they're definitely overvalued, but check this out. If you didn't know, this is really a royalty company. So look, 63% of the revenue is royalty revenue, and the other 40% is their licensing revenue. Super high margin businesses. So if we go to this company's gross margin, they're like a money printer, a 97% gross margin. I kid you not. And then the net margin's like a double digit. So they just print net income every quarter. So every Apple iPhone, every Apple device, every Microsoft device uses ARM's energy efficient chips. So yeah, Morningstar kind of agrees they're really overvalued, but they are high quality, extremely high valuations, pricing and earnings beyond 2030. So yeah, so you're buying a story right now that's pricing in multiples from beyond 2030. It's just too tough to pay, with the strategic risk of competing with its own customers by entering CPU business requires caution. Oh yeah, they're getting into their own CPU business. And like they used to sell a component for chips. Now they're like making their own chips. Wave secured $60 million investment from ARM, AMD and ARM. Anyway, I really like ARM though, but the valuation is really expensive. But I love to own them. AMD is going crazy. Oh, AMD is going crazy. They're at an all-time high. Yo, Monkey D. Luffy, my bad for missing this one. Oh, and Jay, we'll look at URG. Yeah, remind me, please. I see Temp AI. Are you talking about Tempest AI? I've never heard of Temp AI. And if you're going to give me a stock, please give me the ticker symbol of the stock because I don't know a stock just from the whole name of it. NF. But yeah, what's up, everyone? Or whoever, or Biba, who was the one who said that. But anyway, here's Viva Systems. This is a really cool subscription software company. So there's a lot of software stocks to buy on the dip. This is one that's one of the more attractive software stocks to buy on the dip. And this one specifically only trades at a 26 forward PE. And check this out, 85% of the revenue is their subscription business. So if you're looking for a subscription model company, this one's really cool. Analysts or investors love subscription model companies. It's all reoccurring, it's predictable. And this is up 16%, after grew 17, after grew 14, after grew 16. So they're on a great streak of subscription revenue growth. And it's not just revenue. So the revenue is 835 mil, up 15%. Yeah, if we zoom out, revenue hits a new record every quarter. So revenue hits a new record every quarter. It's not just the revenue, but after-tax net income as well. This quarter specifically is the most profitable quarter they have ever had in history. Same with free cash flow. So we're seeing a disconnect between like the fundamentals in the stock price. Like the stock is falling because of software sentiment. It's not falling because they're missing on their numbers and not hitting new all-time highs in net income. And look at another huge cherry on top is the fact that they have no debt. Look at that balance sheet. They literally have $6.5 billion of cash and zero debt. So they only trade at 26 times forward PE. So Morningstar sees them as undervalued, deeply ingrained switching costs across its life sciences software ecosystem. Oh yeah, this is like I like this one more than a lot of other software names because they're specifically in like healthcare industry, helping out life science companies. And like pharma development. So some of their big customers are like, yeah, Merck, Moderna, UTHR, United Therapeutics. Like I I really do like this software name, and they're so profitable already. So that's just one of the software stocks to buy on the dip, but you do got to be cautious. I don't know if I'm the same person as Jace Love. Oh yeah, hey, oh really? Wait, Plasma. There's Plasma on YouTube and then there's Plasma on TikTok. I thought y'all were the same Plasma. Well, hey, what's up, y'all? Yeah, let me do Tempest. Is that TEMP? Yeah. Oh, Tempest Capital. I'm not finding that one. There's Tempest AI. Let me. Are you talking about Tempest Capital? Yeah, we're not going to cover this one. They're only worth $1.9 million. I'd be real careful with that one. Only worth 1.9 mil. So let's do Teradyne. I'd say let's do Teradyne right here. This is a software robotics company. Geez Louise, look at this. They are at a crazy all-time high right now. So if you've ever owned this stock, congratulations. You're definitely up on your position. Let's see if there's any specific news down here. Teradyne acquires Test Insight to enhance AI device test solutions. So yeah, they are a big semiconductor test business as well. So let me see if we can find that. Yeah, look, semiconductor test is 80% of their business, but then they have this growing robotics business where they really do have some nice patents and IP, but they are expensive. Morningstar sees them as overvalued. While the firm will fundamentally benefit from the surging AI infrastructure demand and increasing chip complexity, the market's excessive pricing of long-term growth and near-term margin expansion requires caution. So yeah, it's just a little expensive at current valuations, but it's a high-quality stock if you can get into them. And like if you've ever bought them before today, you're definitely up on your money. Looks like the profits aren't as high as they were back in 2021. But looks like the growth is starting to come back though. Let's actually see what the future or next year's analyst growth are. So yeah, actually, wow, revenue is going to more than double or basically double. Revenue is going from 650 to 1.17. That's actually insane. So revenue's growing and same with net income. Net income's going to 3x. It's going from 80 mil to 290. So actually there is a lot of growth happening just in the next year. That might be what's sending the stock up. Oh yeah, let's do the Tempest AI right here. Okay, I think, yeah, TEM. Tempest AI, I believe this is a gene editing company right here. They're in like genealogy or, that's not what it's called. It's called something else. But anyway, yeah, look at this number one business, or at the number one line. Diagnostics business revenue more than doubled. And this was driven by an increase in oncology and hereditary test volume. So I don't know if this is like some DNA testing company, but anyway, their data and applications grew 25% and profitability improved. So it's kind of cool. Morningstar says they're undervalued. Exceptional top-line growth and expanding utility of its AI-driven diagnostic platform will drive long-term value. Yeah, what I've loved about this stock is, yeah, if we go to the just revenue, check this out. I mean, it's this quarter specifically, look at this. It's up 82%. Last quarter's up 84, and it was up 90, 75, 35. That's after it grew 46. So they're on an incredible revenue streak, but they're still struggling with net income positivity. They are still losing like 40, 50 mil a quarter. But what are analysts projecting? So, okay, they're not supposed to get profitable anytime soon either. But I think investors are just happy about this top line growth. As long as they keep on beating this top line, they should be fine. But yeah, definitely that profitability is something that's probably keeping the stock down because they're the same prices they were back in 2024, maybe because they just can't get profitable and they're still pretty far away from profitability. But there's some oncology test thing is really growthy. Morgan said what app is this? Yeah, hey, if you'd like to get this app I'm on, it's a brokerage. It's on my link tree in my bio, the very first link on my link tree, if you'd like to get it. So it's called Moomoo though. You can just type it into Google, but that's my affiliate link if you'd like to use my affiliate link. This is my favorite. All these are brokerages right here. These are all apps where you buy stocks on. I have Webull, I have Robinhood, I have Moomoo. But I have all these brokerages where you buy stocks on. The best one, the one with the best features and the lowest cost, cheapest fees and everything is this brokerage right here. It's in the link tree in my bio, the very first link. All of them are linked up there. Robinhood second, Webull's third, but this one's my favorite if I just had to recommend one. Okay, let's keep going. Look at some more stocks here. Why don't you own much of the financial sector stocks? Well, I kind of do. I like to think I'm in the financial sector. I got SoFi, Robinhood, Futu, Webull, Dave. But yeah, I don't own like Visa, MasterCard. Those are the quality ones I do need to get into. Can you look into Microsoft? Yeah, let's do Microsoft one more time. I already looked over Microsoft, so this is probably the last time we'll do it, but this is my most recent purchase. Actually, if we go to my most recent purchases in order, I can't believe it. I literally can't believe it. I feel like it looks like I've owned this stock for over a year or something, but we literally bought the stock, boring Microsoft, mega cap Microsoft 2 weeks ago, and we're already up 17%. I can't believe it. So And I think they're going to go higher. They're still down from their peak. They went from 550 to 350. That's where I bought it. But anyway, Microsoft, this is the number one software, number two cloud, and potentially the number one AI play in the world. Microsoft owns 28% of OpenAI. So if you want exposure to OpenAI and ChatGPT, well, Microsoft owns 28% of it, and they're up 17x on their investment. They're also the number two cloud business. So if you heard of AWS, Microsoft is number two. So number one market share is AWS. Then it's Azure Cloud owned by Microsoft. Then it's Google Cloud and then Oracle. But yeah, they're also cheap. They only trade at 24 times next year's net income. Like even after their 15% rally, they're only trading at 24 times forward PE. That could easily stretch higher in my opinion. So anyway, here's their main software business. Think of Word, Excel, PowerPoint. That does over 120 billion of annual revenue for Microsoft. It's insane. And their cloud business also does over 100 billion a year. So if AI is going to take over software, like they're saying, one of the reasons Microsoft falling is they're saying OpenAI and Claude, they're going to replace spreadsheet and stuff, but I don't believe that. And even if it does, Microsoft is hedged as the number one owner of OpenAI. So yeah, they literally print 30 bill in net income a quarter. Analysts project next quarter net income of 30 bill, 31 bill the quarter after. So yeah, this is your way to get exposure to software, cloud, and AI. And in my opinion, and you get games like they literally own Minecraft, they own Xbox, like they have so many other investments too. So yeah, 24 times PE. Morningstar says they're undervalued. Expansion of the cloud environment, rapid growth of AI workloads through Azure, and strong migration to higher price Microsoft 365 tiers will serve as robust long-term value creation. Pretty cool. So yeah, Microsoft Mag 7, you can't go wrong holding like every company in one way or another uses Microsoft. So someone said PM. Oh yeah, then we got to get to URG and Synopsys. Yeah, remind me to get to those. I apologize. What's this app? Yeah, hey, again, this app I'm on, it's actually a brokerage where you buy stocks. So if you'd like to get this brokerage, it's in my link tree on my bio. It's the very first link there. It's a brokerage called Moomoo. You can just type it into Google, but if you'd like to use my affiliate link, it's on my link tree, first link. So yeah, here's Philip Morris. This is they own Zen, and that's what's really led to a lot of the growth. What is this? White paper advocating renewed focus on smoking dangers. Anyway, yeah, so this is kind of a declining industry, but the growth has really come from their the free business right here, which is Zen. And that's led to nice double-digit growth in this segment. They're up good on their investment. It's up 12%, after grew 10%, after grew 35% year over year. But basically, this is a dividend play. If you buy PM right now, no matter what, you're getting 3.6% of your money back in a dividend every year. So you get basically 4% of your money back in a qualified dividend every year. And then on average, you get like 3 to 4%, like 3% stock price appreciation on top of that every year. So, yeah, and they only trade at 19 times forward PE. So there you go. This was a original spin-off from Altria MO, which is another one that has a really high yield, 6.5% yield. That is safe. So yeah, there's Philip Morris. Can't really talk about that industry too much because I'll get in trouble. So that's why I'm kind of not talking too much about that one. All right. I just need to look into how to use it. That's why I'm listening to you. Hey, thanks, Edward. I appreciate you. Yeah, hey, I sell nothing. I have no course book. The only way to learn is just watch the stream. How about Rio? Let's do Rio. This is a commodity company. They mine like aluminum, iron from the ground. They own railroad networks. UEC bought a uranium mine off Rio Tinto. And maybe they're in uranium as well, I believe. So yeah, okay, so iron ore, that's half the revenue. Aluminum, lithium, that's big in batteries. Copper. So yeah, if you want exposure to all these commodities, you can own the people that actually mine them. And if you look at the actual commodity of a lot of these, like the commodity of copper and the commodity of aluminum, they're close to historic all-time highs. So commodities at all-time highs, their price per break even, like they're just going to be milking net income on this. So yeah, this is in US dollars as well, but they're headquartered in China, I believe, or no, UK. So they're headquartered in UK, London. So that's why they report in halves. That's why it says full year in H1 or first half. So yeah, for the full year 2025, they really did keep an after-tax net income, 10 billion in net income. Full year 2024, they kept 11 bill in net income, and then 9 bill, and then dang, full year 2021 was 22 billion in net income. But right now, if you buy the stock right now, they only trade at 16 times net income and only 12 times next year's net income. So it's one of the better commodity stocks with the good yield. You get a 3.8% dividend, but the dividend does kind of change every year. It looks like it's kind of trending down, but also the net income has trended down. In 2021 was 22 bill in net income. Now it's like 12 bill, but still the stock's at all-time highs. Nice little, and recently with the price of these commodities going up, I'm sure the future projections are crazy high. Oh, watch out for that person in chat there. Let me block them. Okay. Look at PE ratio and not PEG. PEG, that's the price to earnings growth ratio. Yeah, you can do like a multiple year out ratio there. But yeah, I'd like looking at the forward PE. It's basically just next year's net income as a multiple. So Johnson Control. Oh, well, let me do URG. Then we'll do Johnson Control. So here's UR Energy right here. Unfortunately, this stock is the same price as they were back in 2010. So you bought the stock in 2010. It's the same price that it is today. So they're a uranium company. That's the category they're in. Do they have revenue though? So they have revenue, but it's really low. Like you just want to be so careful with this one. Like the revenue is 10 to 20 mil a quarter. And on this 10 mil of revenue, so that's the rough part. They're not profitable. Kind of for all of history, they've just lost like 20 mil a quarter. So they're losing like 20 mil a quarter. What's the whole company worth? 650 million. So here's why I think the stock has done not too well since 2010. Kind of think about this. The whole company's worth 650 million. If you buy them, it's like buying a company that loses, 60 million of net income a year, which is 10% of the entire company a year. So looks like the leverage did just go up as well. Did they like acquire an asset or something? I don't know. But yeah, look at the liabilities. They kind of jumped up there. Yeah, the ratio went from 46 to 72. That's rough. But anyway, yeah, that's the only bad part is the net income they're losing, because they're losing a lot of net income, and the revenue, it's actually declined year over year. Revenue's down 53. Last quarter was down 1%. So out of all the uranium stocks to buy, I don't know if I'd buy that one. There's the ticker symbol URA is the global uranium ETF. My favorite uranium play, if I had to pick one, would be Cameco CCO. It's expensive. Then my next pick, this is the company I was talking about. We were just looking at Rio Tinto, RIO. Rio Tinto sold a uranium mine to UEC, Uranium Energy, and it's a great mine that makes good money. LEU is another good one. There's also Solstice. So those companies actually mine the uranium. Here's another kind of uranium play. This is another really cool one I think you'll like. This is Solstice right here. They own the only uranium conversion facility in the U.S. Let me show you this right here. If you read the third line here, Solstice owns the only uranium conversion operation in the U.S., which will see higher sales from growing nuclear power generation in the coming years. So yeah, Solstice is really cool, and they only traded like a 30 forward PE as well. I became a title. Hey, dude, Plasma, thanks so much for always being here. And hey, Dave, actually, Dave said CPB has a 9% dividend. Oh, Campbell Soup. Okay, so here's Campbell Soup. Usually this does good in like a war. Whenever a war happens, Campbell Soup goes up, but actually a war just happened and this one did not go up. So anyway, they own some brands like, all the soups. They own Goldfish. Let's see. So meals and beverages and snacks. Let me go to their website. I wonder if I can find like their family of brands to see all the brands. Okay, here we go. So here's kind of the brands that they own. Yeah, Goldfish. I guess Snyder's. Ooh, I love kettle chips. Actually, I tried these. They're really not that good. Anyway, there's Campbell Soup. Let's go check out how the revenue's doing. So honestly, it's not just Campbell Soup that's doing really better now. If you look at Campbell Soup stock, it's like down to the right. It's not just them. If you look at like a General Mills, yeah, look how similar the charts look. It's almost identical. General Mills is also at like this multi-year low level. So it's not just a Campbell Soup problem. It's kind of like an industry problem. Basically what's happening, or I don't know if this has happened yet, but basically people on Ozempic, they don't eat much, obviously, but when they do eat, they crave like protein-rich meals. And I don't know. Let's just go see how they're doing. So revenue, okay, so this is one of the issues, the organic revenue, the lifeblood of the company, the sales, it did decline. So sales are down 4.5% year over year, but they're still printing good net income. Yeah, they're making over 120 mil of after-tax net income a quarter. And if we average that out or look at the forward multiple, yeah, you're right. You're right. They only trade at 9.8 times next year's net income. So it's like, how much cheaper can they get? Only trade at 9.8 times net income. So there you go. One of my favorite food stocks to buy the dip is also Mondelez. They own like Oreo, Toblerone. I just like their brands a little bit better. They haven't dipped as much, but I really like them. Like so. All right. Next up, ooh, I saw Broadcom. Oh my goodness, I feel bad. I haven't seen this stock in. Oh my goodness, I haven't seen someone mention this stock in like a year. Here's Lucid right here. We've been bagging on Lucid forever. So I feel bad if you own this stock. I really do. Here's why the stock is at an all-time low. It's probably just going to continue to climb lower. But basically, it just all burns down to net income. For all of history, it's like they sell EVs, they sell electric vehicles, and that's already a highly competitive, super low margin business. And they are losing a lot of money. They're losing $1 billion or $500 million to $1 billion of after-tax net income a quarter. So losing $1 billion a quarter, and they're issuing shares while the stock is at all-time lows. Hey, look at that. Uber actually owns shares. Uber went to a partnership with them. Uber owns some shares. But yeah, basically, I would not want to be an owner in this company. They're super leveraged, the most leveraged they've ever been. They have been diluting shareholders while the stock's at all-time lows. So yeah, don't buy that one. Again, they lose $900 million a quarter. Actually, they've lost, look, the whole company is worth $2.66 billion. The whole company's worth $2.66 billion. Just in the past 2 quarters, they've lost, or 3 quarters, they've lost over $2.2 billion. They've lost more than the whole market cap. They've lost their market cap in the past year in net income. So yeah, hopefully that kind of makes sense. I just would generally, like any stock that looks like that, it always explains, like the financials always explain why a stock looks like crap. And that's why we only look at financials on the stream, because that's what really moves the stock in the long run. Like ChargePoint right here, all this company does is lose 50 mil a quarter. And when you lose 50 mil a quarter and your whole company's worth 150 million, no wonder your stock's at all-time lows. This is actually one of my biggest losers ever. One of the first stocks I ever bought. I sold it a long time ago, but this is what really made me focus on financials. Like this is what really disciplined me to make sure like I really like know what I'm buying here. Like, look, here's where I sold the stock. And actually in hindsight, this is a great move. I sold all my shares at $61 a share on that price right there. But look where I bought it. We got to zoom out way, way, way up here. Where's the buy orders? It should show the buy orders. I think the thing's just glitching right now. But no, wait, why isn't it showing the buy order? Okay, I think that my brokerage is just lagging right here. Oh, there's one of the buy orders. Oh yeah, look, there we go. So look, we were buying it way up here, and then we sold it all for like an 80% loss. But thank goodness I sold it all. Anyway, no one probably cares, but yeah, you really just got to focus on financials because that's what really moves the stock in the long run. Oh my goodness, I'm so behind here. I see Vistra Energy. Let's do Vistra Energy, actually, VST. And then we'll get back to like, I saw, what was that? Oscar Health earlier. My bad, Clay. I'm missing out on some of these. I apologize. And oh, what's up, Jack? You said ASTS. What's up, Michael? Look at CAG. I bought PTLO. The market has gone up on a short squeeze. That profit taking will happen. Hey, what's up, Michael? Yeah, I'm curious for what will happen next week. So here's Vistra Energy. This is a nuclear play. They own like 6 nuclear reactors. They're like probably the second best nuclear play in the U.S. Behind Constellation Energy. So they're a pretty cool company. They only trade at 18 times next year's net income. They had a slight one-time adjustment last quarter. So yeah, they only traded 18 times next year's net income. They basically sell, they're an unregulated utility selling electricity to the PJM auctions. And basically in the PJM area, which is like this group of like 8 states, the price of electricity has gone up like crazy. So, or they can sell their electricity at a much higher price. Basically, this company powers data centers with their nuclear reactors, but they're also big in natural gas as well. So it's like a natural gas nuclear combination. So Morningstar says they're overvalued. While company benefits from surging data center electricity demand and AI integrated retail wholesale model, investors are severely underestimating regulatory risk, potential long-term margin compression, and the volatile nature of energy commodity markets. Dang, well, that was extra bearish. Are they that bearish on CEG? Oh, yeah. Wow. Look at that. They're saying CEG is overvalued too. So, yeah. Anyway, I actually like CEG a little bit more. So, Vistra Energy owns like 6 reactors. This company owns over 30 nuclear reactors that are active. This is my favorite nuclear play. So, if you like Vistra Energy, you'll love CEG. But yeah, Vistra Energy is another one I do like. But it looks like there's some regulatory risk. Oh, yeah. Johnson Control. Let's get to this one right here. So, they do like, I think, complex MEP work, so mechanical, electrical work, or let's see exactly if we can find let's go to their website and see if we can see what their products are. Okay, no, reject all cookies. Okay, we're not really building automation and control. So probably like high tech, like control systems, or anyway, let's go to so they're headquartered in Ireland. So that might be one thing to know. They're headquartered in Ireland. So this isn't a US company. So, but this is in US dollars that we're looking at. So revenue's kind of growing mid single digits. Look at this. The revenue's up 6.8. Last quarter grew 3.1. So we kind of want to see the revenue growth grow a little faster than like single digits, but they're printing money, like for real. They're making, here's they had a one-time adjustment last quarter. It says they made 1.7 bill. They didn't actually, they made 830 mil. But yeah, they make consistent profits every quarter, around like 800 million of net income a quarter. So yeah, they only trade at 26 times PE. But notice the forward PE. Oh, well, actually, they had a one-time adjustment. That's why. So yeah, the current PE is not actually that low. Because it's including the 1.76 bill, which makes their EPS look like it was $2.67, but it wasn't actually. So anyway, they traded a 29 forward PE. If you buy the stock now, you're getting over 1% of your money back in a dividend every year, or 1.1% of your money back. So yeah, this just seems like a nice company to benefit from potentially data centers right now, with their complex electrical solutions. Johnson Control. They kind of remind me of like a Powell Industries. They do the switchgear solutions. All right. ASTS. Yeah, this is a cool space company right here. So ASTS SpaceMobile, if you buy them now, you're basically buying the company as they convert from a revenue-less company to a company that prints real money. So you won't believe this. It's so impressive. The revenue's going from the same time last year, it was $1 million. Now it's going to go to 40 million. So if we just zoom out on the revenue right here, a year ago, this was a junk company. They did 1 mil of revenue a quarter. But this quarter, it was 55 million of revenue, and it's not done here. It's supposed to go 36 and then 39 mil a quarter after. So yeah, you're buying a company going from 4 mil of revenue a year to like 200 mil of revenue a year. So that's why I think the stock has had so much crazy momentum recently, pricing in that future growth. So yeah, they assist with like space launches. They're not anywhere near profitability, but let's see. ASTS SpaceMobile scheduled its Bluebird 7 satellite launch on April 19th on Blue Origin's Glenn mission system. So cool. Anyway, they kind of remind me of like a Rocket Lab, SpaceX almost. So yeah, it's one of the space stocks to buy. I would still keep this one as a small position. I wouldn't probably own too much of that one, but the momentum's probably in your favor there. Futu stock. Yeah, let's do Futu. My bad there. So if you're wondering what is Futu, that's actually the app I'm on right now. So this stock, ticker symbol FUTU. If you look at the top of my screen, this app is called Moomoo, and then this stock right here is called Moomoo. So basically, this stock we're looking at is this app I'm on right now, publicly traded, this brokerage. And here's what's so incredible. This stock, and again, even if this brokerage goes bankrupt, you're still FDIC insured for $250K, but it's good to see that the brokerage is doing good. They're printing money. Here's the revenue. They did 830 mil of revenue, up 45%. And on this 830 mil of revenue, they kept after tax 433 mil. What app is this? Hey, this is a brokerage. Or yeah, hey, this app I'm on, it's a brokerage. If you'd like to get this app, or it's a broker, link tree in my bio, very first link there, where you buy stocks on. But yeah, check this out. They did 433 mil of net income. So that means their net margin was a 52%. The net margin's up 25% year over year. It's incredible. So yeah, they collect brokerage commissions and interest income. So yeah, basically, here's what's so cool about this interest part that's up 50% year over year. This app gives you for free a 3.35% APY on your idle cash. So if you keep cash in here for free, you don't even cost you nothing. You earn a 3.35% APY. Well, they actually earn like a 3.8% APY, and they just pocket that little difference on your money. So kind of cool, interesting business model they do. All right, so that was Futu, yes. And full disclosure, I do own this stock. I love this whole industry. So yeah, Futu, I got 14 shares in them. I also own Robinhood stock. I own SoFi. I own Webull. I'm a big fan of the whole fintech industry, like the picks and shovels fintech play. And hey, Life Wonders, no way. Thanks for all those roses there. If you got a stock you want to look at, let me know there. Thanks for all those gifts. So have you done, we have not looked at Broadcom. We got to look at Broadcom after this. And I apologize, I'm a little behind here. Campbell Soup uses bioengineered ingredients. Yeah, I'd believe it. TAN is a solar ETF. Oh, hey, like TAN. Okay. So Solar, let's see what their top holdings are in this ETF. I'm hoping First Solar. So yeah, this is the number one, the best solar stock in existence, in my opinion. If you were going to buy an individual solar stock, I'd pick First Solar. But here's the ETF right here. So if you don't know which solar stock to buy, you could buy this ETF right here, and it's done great. Look, it went from 27 to 55. It's basically doubled in a couple months. But anyway, it owns Enphase, Next Power. How's Next Power done? Actually, Next Power has done super good. Jeez, actually, I haven't looked into them. Yeah, they print net income too. Actually, they might be just as good as First Solar. Yeah, so I wouldn't buy Sunrun and Solar Max and Solar Edge. Yeah, these are junk. That's what probably led this ETF to not be at all-time highs because of some of the lesser quality solar names. But anyway, interesting ETF. Yeah, Quantum's going crazy. Wall Street party goer. Yeah. Actually, everything's just kind of been on fire. Like actually, specifically on Friday, you could have owned anything. You could have owned small caps, mid caps, interest rate sensitive, Bitcoin. Like, everything was so green this past week. So yeah, congrats if you owned any stocks. Sound, please. Yeah, I would not own this company, or I don't love the long-term thesis. So basically, you pay this company every month. This is a subscription model company. You pay for their subscription, and basically you give them a bunch of your voice's data, and it can replicate your voice with a prompt. So basically you give it some text and it'll replicate your voice. I've actually used their website, and it still doesn't sound real. It still sounds like AI. But anyway, their subscription revenue is literally, like if you're a shareholder of this stock, this is the number you look at, the subscription revenue. It's 43 million this quarter, up from 24 million, up from 4 million. So that is insane. 43 mil of revenue. It's a record. So record subscription revenue, and it's all reoccurring. So kind of cool to see that. What about the royalties revenue? So royalties, not too bad. So anyway, you still want to be careful because they're losing a lot of money still right now. Like I guess storing this on a cloud or something. They're losing 40 million a quarter. So that's one bad thing. Losing 40 to 50 million in net income a quarter. But it's basically you just focus on this top line revenue growth. As long as they keep them growing the top line revenue and narrow their losses, the stock will probably just continue to have positive momentum. But I don't know about the long-term thesis because there's other free alternatives like Apple now has in the settings where you can, they'll replicate your voice for you. Oh yeah, watch out for that guy in chat there. Hold on, let me ban him. Yeah, watch out for people impersonating me. I'll never follow you, DM you. I sell nothing. All right. Please UNH before earnings. Yeah, hey, I don't love UNH. Let me come back to that one. Let me get to Broadcom because that one is one I wanted to get to for a while, but then we'll get to UNH, or we can look at ServiceNow. But yeah, UNH, that's your insurance company, really just all in the government's hands. But here's Broadcom right here. This is your custom chip play. Pretty cool. So Broadcom launches VMware. So yeah, actually Google's a huge customer. So Broadcom extends Google TPU partnership through 2031, expands collaboration with Anthropic by nearly 50 billion in already secured orders. So they are having a ton of future growth. So you won't believe this right here. If we look at the revenue expectations, this is why the stock is crazy. Revenue is supposed to hit in 2 quarters, 29 bill of revenue. And on that 29 bill of revenue, they're going to keep 12 billion in net income. So look, if we zoom out to their current net income, it's never even been close to 12 billion before. Last quarter was 8.5 billion, which was incredible. But basically what I'm trying to say is the growth is not done. The growth is like only just begun because revenue is supposed to literally double, almost 100% just revenue growth. Revenue going from 15 to 30, net income's going from 4 to 12 billion. So EPS/net income is going to grow 300%. So that's why you don't look at their current valuation because they currently traded 80 times net income. But the forward PE is getting cut in half because the net income's doubling. They only trade at 40 or 38 times next year's net income, which is still expensive. That's the tough part. They're at all-time highs. Would I buy the stock at all-time highs? No, but I can totally see why they're at this price. And I would not trim or sell out of them if I was a shareholder. I mean, there's so much future tailwinds, and I bet you they're just going to beat on these net income and revenue projections with the Google and Anthropic new deals and stuff. And they have the big VMware business. So yeah, here's their semiconductor solutions business. Like it's already picking up the growth. Revenue's up 52, after grew 11, after grew 4. So the growth rate's growing and it's only going up from here because of the TPU business. So yeah, I love Broadcom. And you get a dividend. Yeah, Plasma said, I always take what Morningstar says with a spoonful of salt. Yeah, that's probably a good idea. What is Asters? Hey, if you give me the ticker symbol for that one, Sheldon, we'll check it out. Have you ever looked at SO? That I rather Matt buy Rest of those being get paid dividends. Yeah, actually, have I ever looked at SO? Yeah, as a shareholder of SO, which is Southern Company, absolutely. This is one of my favorite regulated utilities. So what's so cool about this stock is, look, if we just zoom out on the price, always for history, this stock just gives you like 7-8% of your money back a year. And they're still cheap in my opinion. If you look at the right, the forward PE, or actually I should analyze this on this brokerage right here. But yeah, Southern Company, if you buy the stock right now, no matter what, you're getting 3.2% of your money back in a dividend. So you're getting a high yield, 3.2% yield. And look at this valuation. They only trade at 20 times forward PE. So they're basically just benefiting from electricity demand from data centers. So it's a regulated utility, and they now have a perfect excuse to go to the regulators to raise prices. So yeah, you get a 3.2% dividend yield. I personally own 11 shares of this company. We bought them just like not even that long ago. It was during this dip right here, which was like just a few months ago. So yeah, I love Southern Company. If you don't know which utility to buy, you could just buy the whole VPU ETF. This owns all of the top utilities, and utilities is such a great sector. Look, here's the ETF of just all the utilities for all of history. It's always just gives you like 7 to 10% of your money back a year. So you get 3% or 3 to 4% in a dividend, and then 3 to 4% stock price appreciation. And with the new data center tailwind, I mean, that they should only benefit more. Electricity is such in demand. So yeah, great utility there. And that's the only regulated utility I own. So I own a regulated utility, which is a Southern Company, and then I also own one unregulated utility, which is CEG, Constellation Energy. Both of them are actually near the same amount in market cap and valuation. NVIDIA is so cheap right now. Yeah, Gabe, actually, NVIDIA is cheap. NVIDIA only trades at, right now, 24 times forward PE. So even though NVIDIA is basically at an all-time high, only at 24 times net income at an all-time high, which is why I think they're going to go higher. So what about Snapstock? It's Snapchat. Yeah, this one you got to be careful with because they just can't get profitable. But hey, I guess this brokerage is telling me that there is a bullish continuation wedge. So there you go. That could be some interesting things there. But yeah, this stock is at an all-time low, lower than it was when they IPO'd in 2017. So yeah. Okay, so Morningstar says they're undervalued despite intense competition and near-term headwinds, profitability, expanding international user growth, improving ad targeting, and traction in high-margin subscription offerings like Snapchat Plus will drive long-term value. So yeah, here's their active users. Snapchat has 474 million daily active users, which did actually fall year over year. Same time last year, they had 453. Now it's, oh no, that grew. Never mind, I'm stupid. So it did grow by like 20 million daily active users, but they just can't get profitable. If we just zoom out, for all of history, they've just burned a lot of net income every quarter, and they're still not expected to make any net income anytime soon, or they're supposed to lose 130 mil next quarter, 175 million the quarter after. So basically out of all the stocks like this, I would much rather buy a Reddit, maybe even like a Pinterest. You also, as a shareholder, get no voting rights. The negative net income almost perfectly matches the stock-based comp taken by the insiders. So Tencent's the largest shareholder, which is a Chinese stock. But yeah, fortunately, the fact that they're so far away from profitability scares me. But I do find interesting, the Snapchat Plus, basically, they're kind of getting some heat right now. They're forcing all Snapchat players, people, if you want to see your memories, like see your previous memories, you have to pay for their subscription now. And it's upsetting a lot of people. But that could bring a lot of subscription revenue for them. All right. Oh, First Solar. Yeah, here's First Solar again. This was that solar stock we were talking about a minute ago. If you're going to individually buy a solar stock, this is the one I'd pick, not financial advice, because they're super profitable every quarter. Like when Enphase was losing a bunch of net income, this company was making a bunch of net income. And look, this quarter specifically was record net income. It's never even been higher before. 520 million of after-tax net income. What's the net margin on that? So yeah, 30% net margin. So that's a good margin selling solar panels. So yeah, they're making like 400 or 500 mil of net income a quarter. Get exposure to solar. Really good balance sheet. Really good fortress balance sheet. So yeah, 10 times forward PE. Morningstar says they're reasonably valued. While a leadership thin film solar technology and significant U.S. manufacturing incentives provide near-term cash flow, near-term capacity headwinds and heavy reliance on favorable trade policies warrant investor caution. So I guess you just got to worry about trade policies or something like that. But anyway, 10 times forward PE is just cheap for a solar play. All right, we'll look at a few more here. Yeah, what's up, Brett? What's up, everyone? Hope y'all are having a great Sunday. Yeah, we've been live for over 2 hours now. This has been fun. But we'll definitely check out a few more stocks here. By the way, if you want to hit the follow button, we stream every Sunday this exact same time. I try and stream every day. I sell nothing. I have no course book. I don't coach. Literally sell nothing. Just on here give my opinion. LH said Zscaler if you can. Yeah, here's a cool, I think, cybersecurity cloud company, or mainly cybersecurity. Uh, let's see how they're doing. Is there any news? No specific news around this stock, but yeah, if you just look at any software company right now, like Adobe, Salesforce, ServiceNow, it looks very similar to Zscaler. So this one, if we just zoom out to the revenue, this is what's so impressive. Like this is what you want to see if you're going to diamond hand a growth stock, where the revenue just hits a record every quarter. So literally, not every year, but every literal new quarter is a record new revenue. But the bad news is they still aren't profitable. They actually lost, they're starting to head back in the wrong direction. They lost a lot more money than they did the same time last year. So the bad part is we just want to see this company try and get profitable really soon. Are analysts projecting that? No. So they're actually supposed to lose more money than they lost the same time last year. They're going to go from losing 17 mil to losing 25 mil. So the losses are supposed to worsen, but the revenue is supposed to grow. Revenue is supposed to go to 880 million in 2 quarters. So that's the only one thing you want to watch is the net income and potentially the AI fears. So Zscaler from Morningstar says they're undervalued, accelerating enterprise adoption of zero trust architecture, the secular convergence of networking and security, basically an increasing cybersecurity demand driven by new AI models will drive long-term value growth. So yeah, top line revenues there. We just want to see them, like they have no forward PE, so it's kind of hard to value this company because they're not going to make any net income for over a year. So that's a tough part. Yeah, bro. Hey, try not to spam there. What is this one? HNRG. I don't know. Not heard of this stock. So let's check it out. And then we'll look at BlackBerry. Yeah, hey, we'll look at BlackBerry. Is that BB, right? And I see Comcast. Do you ever vote in your stocks? I feel like a few shares is never. Yeah, I've actually never voted in any of my stock shares. It's just not worth the time for me. So here's Hallador Energy. Maybe if I had more shares, but let's see what this company does. So electric operations. So I'm sure that's maybe benefiting from data centers and coal. So this is a coal play. I know I don't know how in favor regulatory wise coal is, but maybe this could be an interesting coal play. So thermal coal is the energy that they're in. So they're not profitable. Well, actually they are. So do they have a forward multiple? That'd actually be interesting. So they don't have a forward PE, but do analysts just not cover them? Okay, so analysts just don't cover them. Okay, so it's not like they don't have a forward PE, it's just analysts don't cover that. So it's just such a small company. Interesting here. Actually, technically, before tax, these are the before tax numbers. So before tax, for the past 4 quarters, they have made net income every quarter. So that might be interesting to see. Anyway, some sort of coal play. The stock's done pretty good. I know there's some other coal stocks. I forget the name of it. Is it like AMR? I think it might be this. Yeah, this is another coal play. Actually, it looks very similar to the other stock where it dipped way back here. This is another coal operation play. Huh. Are they profitable right now? No, they're actually losing money. Dang, organic revenue's down bad. I know coal was popular like a couple years ago. All right, let's look at some more here. Oh, Synopsys, what's this platform? Yeah, hey, this platform I'm on is called Moomoo. If you'd like to get this, it's a brokerage where you buy stocks on. If you'd like to get this platform I'm on, it's in my link tree in my bio there, the very first link. So, Synopsys, that's actually, we're not going to cover that one. Yo, Mike, what? Bro, try not to spam like that. That's not cool. What was the other stock? Oh, yeah, BlackBerry I said I'd get to. Yeah, let's do BB BlackBerry. Sometimes I just get lost in the chat and I'll forget some stocks, so I apologize. When we think of BlackBerry, we all think of the phones. Like back in the year 2007, this was a $230 stock. Now it's a $4 stock. But I guess there has been some positive momentum this past week. Dang, there was a big green candlestick. Wonder if there's any specific news around this company. BlackBerry QNX partners with Marine Systems for global naval defense software integration. It's actually pretty cool. I know they have some. This is mainly, they've converted from a phone company to an automotive software company. Here's what Morningstar says. They says they're undervalued. Solid organic growth driven by its QNX automotive software and a stabilizing secure communication segment and expanding operating margins will drive long-term growth. So they actually are supposed to stay profitable. Check that out. Next quarter, they're supposed to make 11 mil and then 15 mil the quarter after. So they're supposed to stay net income positive every quarter, which is great news. But yeah, look at this revenue kind of over time. Look at how here was the revenue back in 2012. They were doing 4 or 5 bill of revenue a quarter. And well, it's like not even close to that anymore. So it's kind of like the rebound story, but I'd just be careful. How's their software business going to do? At what age did you start investing? Yeah, hey, I actually started when I was 18 years old. The day I turned 18 is when I started my brokerage account. Comcast, I saw, Comcast, CMCSA. This one's kind of like has a slow, its original business is like a slow bleed. It's going to decline slow single digits, cable. So yeah, if we go to Comcast, this stock is the same price that it was back in, 2015. So the stock's been flat for 11 years. But yeah, for basically the residential connectivity business, as you can see, here's kind of the annual revenue. It just declines single digits every quarter. You know what I mean? So their original residential connectivity cable business is declining, but they're investing in other businesses like they own theme parks. If you heard of Universal Studios, that's owned by Comcast. So they're in theme parks. Actually, for the full year 2025, that hit a record. They're also in the studios like, what's that called? Universal Studios. So, or DreamWorks. So they own like the Despicable Me franchise and a bunch of other things like that. So anyway, that's Comcast. It's just kind of converting from the cable business to moving growth into other businesses. So that's why I think the stock has struggled because of its legacy core cable business. All right. ServiceNow earnings are coming up. And Antonio said INGM. Let's do INGM really quickly. And I'm probably forgetting some stocks. I apologize. We'll do like ServiceNow and CUE. Yo, Jen, remind me to get to CUE. I don't think I've heard that one before. So here's Ingram Micro. The stock is at an all-time high. So if you've ever bought this stock, you're definitely up on your money. So what do they do? Client and endpoint solutions. So is this like a cybersecurity industry? Advanced solutions and cloud-based solutions. Interesting. So revenue this quarter was 14 billion of US dollars. So 14 bill of revenue. And they kept in a net income, 100 mil of net income on that. So that's a really low net margin, a 0.8% net margin, but still they're making a good amount of net income every quarter, and you get a 1% dividend. So you get a 1% dividend. So yeah, it looks like they're headquartered in California. Distribution of information technology and cloud services. Where does their revenue come from? So yeah, okay. The US is only 34% of their sales. Looks like China's 11% and 45% of it is outside the United States, China, and India. Looks like it was saying Europe, Asia area. Oh, okay. All right. Let's do next up. Geez, I'd like sneeze, but the sneeze won't sneeze. Okay. What do you think about Netflix? And with stocks being high, how do you decide which one to throw money in if they're all high quality stocks? The ones that still have fair multiples, but to be honest with you, right now, I'm really not buying much. I spent all my money, 2 weeks ago, buying the dip 2 weeks ago. So I'm really not adding any new money to any positions right now. But if I'm going to add money to a position right now, I'm probably going to buy one I'm like down on, like a defensive name, like an AbbVie or a Progressive Corp, like an insurance company that's not at all-time highs. Because I'm not going to buy this stuff at all-time highs because like the semiconductor heavy stuff, like whenever things fall again, that's the first thing that's going to fall the most. Like AMD just hit a crazy all-time high on Friday, so I'm certainly not going to buy it. But when things fall, that'll be the thing to buy. So I always just buy the stuff that's quality, that's on a dip. So let's do ServiceNow. NOW. This is a software name, and yeah, they are on a massive dip. But it's not just a ServiceNow problem. It's all a software. You even look at Microsoft. You look at Salesforce, Adobe. All the stocks look very similar to this chart right here. So is there any specific news around this company? Earnings release on April 22nd. Okay, so they report earnings literally, today's the 19th, in 3 days. So watch out for that because they report earnings in 3 days. So the ServiceNow CEO purchases 3 million in shares amid the stock decline. That's interesting. UBS downgrades ServiceNow to neutral, cuts price target to $100 on AI automation competitive risks. Dang. I guess they're saying AI is going to replace them. But anyway, let's see. Multiple analysts cut them. What were they saying specifically? UBS noted headwinds from reduced enterprise spending on non-AI or core software. Expects smaller than normal beats in coming quarters and lower constant currency growth estimates. Well, anyway, that's bearish, but maybe that's all. Like that's what's like priced in right now. That's the reason why the stock is way off all-time highs because of the AI fear. So maybe it's all priced in. Actually, Morningstar says they're undervalued. Strong enterprise adoption of its generative AI solutions, robust cross-selling beyond core IT, and best-in-class customer retention rates will drive long-term growth. Like literally over half the S&P 500 are customers, and check out the growth. This is what you want to see if you're going to diamond hand a stock. When the revenue just hits a revenue or record every quarter, literally every single quarter, the revenue just hits a new record. So that's what's so impressive about ServiceNow. It is not just revenue, but also net income. Like they're already profitable. A lot of software stocks are still struggling to get net income positive, but not them. They're already printing 400 to 500 million of after-tax net income a quarter. The free cash flow is insanely well. Dang, $2 billion of free cash flow this quarter. So I'm a fan of ServiceNow, but they might still be a slight tad expensive. Morningstar said they're undervalued. I still think they're slightly expensive because of this forward 40 PE. So they trade at 40 times next year's net income. Out of all the software stocks, that is one of the more expensive multiples. That's why if I was going to buy this one, I wouldn't buy it crazy. Yeah, like if I wanted to buy ServiceNow and make them 5% of my portfolio, I would not make it 5% of my portfolio today, but I'd maybe definitely like go ahead and make it 1% or something, like a small position. But I wouldn't today. This isn't the price where you go crazy yet. When there's others, like because of the forward multiple, but there's other software stocks that there is a time to go crazy on them right now. ServiceNow is a ticketing company, or oh no, they're in software, CRM and stuff. Ooh, yo, we used to work at that. Oh, hey, that's really cool, Orange. No stock, but curious how you learned all this. I just, I'm definitely not an expert. I'm a college student. None of this is financial advice. I'm just on here giving my opinion. But yeah, I've just been in the market for so long, and I just show you the things that I find important, and that's just the financials. And I like looking at the news because that's what really moves the stock in the long run, the financials. All right, next up, someone said Netflix. Ooh, Netflix did just report earnings. Basically, the reason the stock fell is because they raised prices and they lost 2% market share. Like all the metrics were good, like they met on all their expectations, but their streaming market share declined by 2% and they just rose prices on all their tiers. So it's kind of like a bad look, raising prices while losing market share. But that wouldn't scare me out of Netflix. I mean, yeah, they're a huge advertising play now. Their ad tier subscription that's about to hit $3 billion in annual revenue. But yeah, they only trade at 28 times next year's net income. It's an easy company to understand, a subscription model company. A lot of people in here probably have a Netflix subscription, and they just rose prices. Some people are probably like, hey, they have pricing power. I'm not going to cancel my Netflix subscription. So that could lead to future net income going up. So yeah, they just print like $2.5 to $3 billion in net income a quarter. And they don't pay a dividend and they just do share buybacks. So yeah, they actually make $11.69 on average per person per month. And that should only go up if they just rose prices. So anyway, it's still not super cheap. Like they're still at a 29 forward PE, but honestly, I would not trim it. There's nothing to really be worried about on Netflix. Their CEO just resigned. Oh, hey, thanks for that. Dave just said the Netflix CEO just resigned. I didn't know that. Individual stocks are fun, but keep it small. Yeah, that's true. I always recommend keep the backbone of your portfolio in the S&P 500. Most investors and hedge funds literally just cannot outperform the S&P 500's 10 to 15% CAGR. They can't outperform the S&P. So if you can't beat the S&P, like I promise you won't regret this. No financial advisor will be opposed to this. Have at least the S&P 500 as like a small position in your portfolio because when it does outperform you, you won't feel as bad. But after you buy the S&P 500, buy some individual stocks you know and love that are in the S&P, like Google. If you like YouTube, I got McDonald's. I have actually all these stocks are in the S&P. Constellation Energy, United Rentals, Meta, Coca-Cola, Amazon. Buy what you use. All right. Do you trade options? I actually do not trade options. What's up, VF investor? Yeah, I don't do options and I don't own crypto either. So I'm kind of boring, but I promise, like you can get really insane returns just buying and holding high quality just stocks, literally just shares of companies. You can get really good returns, like better returns than the crypto and option people. All right. Yeah, hey, we can cover Salesforce again if you want. All right, let's look at a few more here. Oh yeah, what do you think of CUE? Let's check this one out right here. He's not resigned, he's retiring. Oh, okay. So wait, I looked up CUE. Oh wait, CUE. So Q Biopharma. Okay. I'd be super careful with this stock right here. If you look in the top right, they're only worth 59 million. So the whole company is only worth 50 million. The stock's at an all-time low. Let's see if we can figure out why. So, actually, they made money this quarter. So look at this. They made 21 mil of revenue and they made 1.5 mil of net income on that. Was that like a one-time royalty adjustment though? Like sometimes like a company, will collect like a one-time royalty, or maybe they sold off an asset. Oh, that's what it was. They actually cash from investing activities. They sold off an asset. So basically the company's worth 50 million and the company was losing 40 million of net income a year before today. So there was just real bankruptcy risk, losing whenever you lose 12 mil or $10 million, that's 20% of the whole company. So I'd be super careful here. I don't know. I just would not own this one. I don't know if this was like a one-time royalty adjustment, or we do definitely want to see that continue. Hopefully they can continue to make 21 mil a quarter. Analysts only expected 1 mil, but yeah, it's just some like biotech company, biotech. They got 29 employees. Be super, super careful with that one. I just want to own them. Could be a fun little short-term swing trade as like a really small position though. Um, yeah, sorry, I'm not trying to ignore anyone. There's just so many stocks here. Actually, Alex, I'm not seeing any other stocks you were talking about. Or let me scroll up here. Oh, DNN stock. Is that like what is this one? DNN. What is these meta analysis, please? Oh yeah, Damien, let's do meta next. Sorry if I missed the stocks. There's so many companies. I apologize. But yeah, here's Denshin Mines. This is a Bitcoin mining company. I think they own like Wharf Mine, and well, let's actually see. I guess the app is telling me there's a double bottom on Denshin Mines right now. There's an 87% rise probability. But yeah, let's see what they own. Okay, it's not gonna. Did it used to break it down? I feel like it did. Maybe it didn't. Oh well. But oh no, forgive me. This is a uranium company. So this is a Canadian uranium company. It has nothing to do with gold. Okay, actually that actually makes sense. Actually, let's compare this chart to the price of uranium. So let's overlay this versus uranium. URA. So here's uranium versus Denshin Mine. So yeah, it's almost identical. As you can see, the two charts of this stock, well, it's close to identical. They really rhyme together. You know what I'm talking about? So yeah, this is a uranium play. Let's see what the revenue is. So the revenue, that is rough. I would be really careful. Looks like the revenue is only 900,000. So that's just like a really small amount of revenue. And they're losing money every quarter. But maybe like do they have future projections? There are no analysts covering the future projections here. Anyway, right now it looks like the stock is just like a high beta uranium play. So I would, but like there's no like I can't really trust these financials. You know what I'm talking about? Like I'm not seeing much revenue. They're losing money every quarter. If I wanted another uranium play, you can just actually check out URA, which is the uranium ETF right here. And I love Cameco the most. That's my favorite uranium stock. It's done the best, but they've done the best for a reason because they're the most profitable. Cameco reports uranium price increase. Okay. UEC is another great one. They bought a mine off Rio Tinto. And there's LEU, which is Centrist Energy. And there's even Solstice right here, which refines. So those companies are like the uranium mining companies. They own the mines for the uranium stocks. But this one right here converts it into fuel for nuclear reactors. So this is Solstice, SOLS right here. If you read the third line here, Solstice owns the onlyum. I just said onlyum. Solstice owns the only uranium conversion operation in the U.S., which will see higher sales from growing nuclear generation in the coming years. Yeah, my head's starting to hurt. I've been streaming for 2 hours and 20 minutes, talking nonstop in a room, but I've been having fun with this. Yeah, if y'all want to hit the follow button, I'd stream every day and every Sunday at this exact same time. So we'll look at a few more here before I head off. SPYM is less expensive. Yeah, this is the S&P 500 with a lower expense ratio. You're right. SPYM. Boring is good. Yeah, I love boring stocks. Like a great example, just like a boring stock, but like waste management. Waste management, people always got to throw away their trash and it's kind of AI proof. You know what I'm talking about? Oh yeah, I said I get to Meta. Thank you for reminding me. And then we'll do Duolingo, I see. Yeah, Duolingo. Actually, yeah, remind me to get to that one. We'll do Duolingo next. Vishwa says, what are some good dividend stocks? I have Schwab, JP Morgan, Fidelity. Those are great. Actually, we'll cover some of those in a second here and I'll show you some that I like. I love JP Morgan. Charles Schwab's good. So here's Meta Platforms though. This is a main advertising. It's like an advertising and AI play. So, they have ads on Facebook, Instagram, Threads, WhatsApp, Messenger, and they're just now for the first time ever introducing ads to WhatsApp and onto Threads. So that's like a huge earnings tailwind as them introducing ads to those apps. But also one of the reasons why Meta's been such in the news is because they're investing so much in AI right now. They're spending basically $35 to $40 billion a quarter for the next 4 quarters in a row on NVIDIA chips. So actually, that's not scaring me out of Meta. I love what they're doing. I love the Meta Ray-Ban glasses. Looks like their new Their new LLM model is really good. Meta raises Quest VR headset prices by up to $100, citing memory chip cost. Dang, so even the memory shortage right now, that's hurting PlayStation's margins, Apple iPhones, Microsoft laptops, everything right now, even the Meta thing. So Meta projected to overtake Google as the world's largest digital advertising business in 2026. Hey, that's actually kind of crazy. Wow. So yeah, Meta, number one ad play in the world, pretty much, with now introducing ads to these other apps. They actually make $50 a year per Facebook user. So if you're in the US and you use Facebook, on average, they make $50 off you a year. Isn't that crazy? So yeah, last quarter, they had a one-time adjustment. It says they only made 2.7 bill total one-time adjustment. They actually made their normal 20 billion that quarter. So that's artificially hurting their multiple. It says they trade at 29 times PE. It's not true. They only trade at 23 times PE. Oh yeah, here's their users. Meta literally has 3.54 billion daily active users. So half the world is on a Meta app a day. Here's some conspiracy. China's not allowed on any Meta app. So it's like 3.54 billion, excluding the 15-20% of the world that's China. It's kind of crazy, like how much of the world uses Meta and stuff. So yeah, I'm a fan of this one. They have a net debt position for the first time ever with the Prometheus bond issuance. But again, I like what they're doing. I think they're going to benefit from AI. And anytime they cut back on their spending guidance, the stock just rallies to the moon. Yeah, watch my battery. Yeah, my battery is getting low. So Duolingo, this is one that might get hurt from like a Meta. Basically, Duolingo stock is getting hurt right now because they're saying in 10 years from now, maybe the live translation technology on your Meta Ray-Ban glasses. I own a pair of Meta Ray-Ban glasses. And basically, you can translate stuff. It's not too good, the technology right now, but in 10 years from now, maybe the live translation technology will be so good that you really don't need to learn a new language. Like for school, yes, or something, but like it's not really mandatory to learn a new language if it's so easy to live translate stuff. So that's the one bad part about Duolingo. It's the thesis. So right now, they're not missing on any metrics. Their core business right now is phenomenal. Subscription revenue hits a record every quarter. It's up 40% after 48, after 46, after 50% subscription growth. Advertising revenue is up. So basically, revenue's at a record, profits are at a record, but it's just a 10-year thesis out. And there's also, the stock fell 15% on no earnings, and they fell 15% on the day that OpenAI, which owns ChatGPT, OpenAI is making their own for free language learning app. So basically, you're paying Duolingo to learn a new language. Maybe information will be so commoditized that you can learn a new language for free as AI teaches it to you over Duolingo. But anyway, that's the thesis I think that's hurting Duolingo, because they're not missing on any of these metrics. So yeah, hopefully that was kind of helpful there. I'd be cautious buying a dip. Like if I was going to own them, I'd own them at a very small amount. But it's interesting. What app is that? Yeah, if you'd like to get this brokerage, oh my goodness. They done interrupted me as I'm trying to say my thing. Yeah, they think I'm AFK. I've been streaming for 2 hours and 20 minutes. Okay, sorry, we're back. They said I was AFK. Someone asked what app am I on? Yeah, if you'd like to get this app, it's actually a brokerage. It's in the link tree in my bio, the very first link there. It's a brokerage called Moomoo, and it's an affiliate link too, so it'd help me out if you'd sign up with my first link there. But you can just type it into Google, brokerage called Moomoo. I rarely use Google anymore for search. Really, Google search is actually still, a thing just came out report. Google still owns a 90% global search market share. I wonder if we can find that news out right here. I can't find it, but anyway, Google is just the ETF in one. Did y'all know Google owns 6.5% of SpaceX? And look, read the second line. This originated from a 2015 investment of $1 billion. And today it's valued at over $100 billion. Google has some of the best investments ever. They're up over 100x on YouTube, up over 100x on SpaceX, over 100x on DoubleClick. I mean, Google is a freaking beast, like a huge cloud play, a huge AI play, a huge advertising play, autonomous vehicles. Oh yeah, YouTube Premium. YouTube raises subscription prices for the first time in 3 years. Google Gemini chatbot increases, secures a deal with Anthropic. Google, and I have so much good news. Oh yeah, Google is selling their own TPUs, quantum chips. I could say so much about Google. No one really asked for that one. Oh, Figma. Yeah, this is another one. This is like an Adobe competitor. Actually, this stock fell 10% because of Google, actually. Google created something called Google Stitch, or I think that's what it was called, Google Stitch. And basically, it's a direct copy of Figma. I kid you not. So if we go to Figma stock, this one looks very similar to Adobe. Actually, it looks identical to Adobe. The chart's almost, actually, let's pull that up if anyone's curious. So actually, Adobe tried to buy Figma. Regulators didn't allow it, and Adobe had to pay Figma $1 billion, but they're both experiencing the same sort of downtrend right now. Yeah, Anthropic launches Claude Design AI tool directly competing with Figma's core design products. So anyway, this is another one that you just want to be careful with that is very exposed to the AI replacement thesis. But Morningstar says they're undervalued, and I love their top line growth. Like again, it's another one like Duolingo where they're not exactly missing on any metric right now, you know. Like revenue's up. Wow, revenue's up 40%. Last quarter grew 38, then it grew 40, it grew 46, grew 50. Like at my college right now, a lot of people I know, like they're having to forcefully, they're using Figma. So 303, and I know someone who just made an app with Figma. So yeah, they did 303 mil of revenue, and looks like that was the IPO fear. They project. Ooh, so they're actually supposed to lose net income 135, 163. So they're supposed to lose net income, huh? But the top line growth is there. So I don't know. I'd just be careful with this one. I'd kind of rather buy Adobe, or I don't know. I'd just be careful with Figma. That probably wasn't too helpful. I apologize there. Let's check out Venture Global right here. And then we'll do a couple more here. Must read researcher paper out of Oxford regarding AI human cognition. Hey, what's up, dude? Not bullish on AI. Hey, what's up, Known? US done well. Hey, what's up, Junior? Oh, I forgot to look at the dividend stocks I was talking about. I'm a little behind here. So here's Venture Global right here. I forget what they do. Is it like an indices company? So they're in, oh no, this is a natural gas company. So actually I'll show you their website right here. They have these like Louisiana projects, like LNG cost. Can I get this off my screen? This website, oh my goodness. Okay, they're just forced. There's no way to X out of this video. I guess they want you to watch it. Well, anyway, they own a bunch of LNG projects, and they're basically just now coming online. So the revenue is supposed to go from $3 billion to $5.1 billion. And on that, they're actually, is that real? They really are going to make after tax $1 billion in net income. So really, you do a forward multiple on this stock, and they only trade at 6.8 times next year's net income. So this is an LNG liquefied natural gas company. So kind of commodity natural gas business, but look at that. Get a good dividend yield, 0.5% yield or higher, safe, super low payout ratio. I really wanted to pull up their website right here. So yeah, oh my goodness, dude. Like we did it. Okay, I clicked something. So yeah, anyway, they're headquartered in Louisiana. There's where they're actual, like close to New Orleans. And over here, so yeah, these are, I guess, are their LNG projects right here, these two are already open. So anyway, LNG company, kind of cool. Low multiple. Will Meta split this year? I don't know. Actually, I don't think they would. Probably not until they get to like $900. Not until they're back to an all-time high. Someone said QQQ. Yeah, if you like the QQQ, which is the NASDAQ 100, check out the QQQM. It's actually the QQQ with the lower expense ratio fee. And also, I think BlackRock just came out with its own NASDAQ 100 ETF. Let me see if I can. Let me just look up BlackRock. It's BOK. Okay, BlackRock, they came out with their own NASDAQ 100 ETF. I wonder if it'll show that up, though. Nah. BlackRock's Bitcoin ETF attracts. Well, anyway, QQQ is just the NASDAQ 100, and a lower expense ratio version is the QQQM. But yeah, it just owns all the top S&P. It owns 100 of the top tech S&P companies like NVIDIA, Apple, Microsoft, Amazon, Meta. So it's like a tech-heavy S&P, and historically, it's always beaten the S&P 500 because tech has always just done so well. So yeah, QQQ is a phenomenal ETF. You should just get like 10, 12% of your money back a year. All right, next up, what is Aloka? Hey, if you have a stock, please give me the ticker symbol for that one. What are the most long-term good stocks to invest in for now? It's a good question. What app are you using? Yeah, this app I'm on, it's a brokerage. It's in the link tree in my bio, the very first link there. So yeah, these are the only things that I'm really seeing to buy now because there's so much stuff I wouldn't buy, and that's unfortunate because 2 weeks ago, I could have given you a heap of stocks to buy. That's when I just bought, literally 2 weeks ago, I bought Uber for the first time, I bought Microsoft for the first time ever, I bought AppLovin for the first time ever, but all these stocks are up like 12, 15%, and I can't really recommend them now. But there are still some other stocks I recommend, like an AbbVie. But these are more defensive sectors. Like, I don't know, like the stocks you probably want that are super growthy in the long term, like AppLovin and Microsoft, you can't really buy them now. But there's other sectors like AbbVie, Progressive. These are some other kind of decent ones on a dip right now that I like. Progressive historically has always done super growthy for a boring insurance company. Is it better to invest now or wait a few weeks for the S&P 500 for a big first initial deposit? Yeah, truthfully, like you'd want to wait. And the probably smartest and most disciplined thing to do is slowly dollar cost average. Like if you wanted to invest $10,000, you don't invest all $10,000 next week. You invest only $1,000 next week, and then $1,000 the week after, $1,000 the week after, because like chances are, I don't see the S&P 500 going up crazy much higher from here. So potentially all the buying in the future will be at a lower cost than here. But also at the same time, like valuations are still cheap, and I can see the S&P continuing to climb higher. And for all of history, buying the S&P 500 at an all-time high has always been the right move, like because it always just keeps on going higher. So if you are like me and plan to never sell for 20 years, it really doesn't matter if you buy it now or buy it 5% lower in a month. It's going to continue to win, and it's a great long-term buy, never sell kind of thing. So, but yeah, I definitely probably wouldn't go all in just next week. All right, let's see. Next, Tempest AI. Oh yeah, we were looking at that one earlier. I guess we can pull that one up really quickly. Tempest AI. This is a diagnostic company, so they're benefiting from oncology. Basically, their diagnostic business revenue more than doubled, and that was driven by an increased oncology and hereditary test volume. So it's some kind of like DNA hereditary testing. And they have incredible revenue growth. I mean, check this out. If we just zoom out, revenue hits a new record every quarter. So the revenue is up. Revenue's up 82% this quarter. Last quarter's up 84, 89, 75, 35. And that's after it grew 46. So just incredible top line growth. But the bad part is they're still struggling to get net income positive. They're not losing that much money, but it's still not good to see them lose a lot of net income like this. And they're not expected to make any net income anytime soon. The net income loss, they're actually supposed to lose more net income, 90 mil and then 80 mil. So what we really want to see is them narrow them losses. And that's what they did this quarter. They're expected to lose 63. They only lost 54. So yeah. I think that's why they've been flat for a couple of years, but I really like them. It's like a unique, there's not many of the, like a test company or oncology business too. Interesting. Can you look at SOXL? Is that the semiconductor ETF? Oh, this is the 3X semiconductor ETF. So basically, whenever SMH goes up 1%, this goes up by 3%. So basically, this is like options. You can basically buy shares of this and it moves super fast. So this is what, like if you're a day trader, short-term swing trader, day trader, this is probably a tool for you. It's a tool, you definitely don't just buy and hold this one forever, but you buy this if you want volatility. You know what I mean? There's also like TQQQ, which is the triple NASDAQ ETF. Bitcoin is actually historically always traded at like a 3x beta to the NASDAQ. So Bitcoin historically is always like a 3x NASDAQ beta. But anyway, yeah, the TQQQ is the 3x NASDAQ. All right. VOO is better than the SPY. Yeah, both move identical, but it's just like S&P versus Vanguard. What about DXYZ? DXYZ stock. Wait. I've not heard of that one. I'll see if I can find it though. Destiny Tech 100. Okay. Destiny 100. Is this like must be like a blank check holding company then, or is that what this is? Yeah, non-diversified closed-end fund. Closed-end management investment company. So yeah, they own a stake in a bunch of different stocks. Maybe we can check out their website right here. Design is the portfolio. What do they actually own though? They got 32 companies. Well, what are they? Current portfolio. So they got SpaceX. Okay. So SpaceX is 16% of them. Shield AI, Databricks. They got XAI. They got XAI in here. OpenAI, Kraken. So it looks like some private equity stock right here. So yeah, they're worth $680 million. So yeah, I guess that's a way you can get exposure to SpaceX. I guess the whole business itself only owns 600 million of SpaceX, and that's only or not even. But anywho, that kind of reminds me like the Robinhood Venture Fund. Another similar one that might be better, I don't know, is like if you go to RVI, this is the Robinhood Venture Fund. It owns some very similar companies like Databricks and all these companies right here. So yeah, anyway, let's keep going here. Oh, dude, no way. Dude, Crafty. What the heck? He just gifted a paper crane, dude. That was so cool. Dude, if you have a stock you want to look at, let me know. I really appreciate that. So, are there any good virtual reality companies? Honestly, this is kind of crazy, but like Meta. I don't know of any other real, like, this was the original, like, metaverse, virtual reality, Meta VR headset. I like Meta as a great play for that. And look at this. Actually, Meta just raises the Quest VR headset prices by over $100, citing memory chip cost surge from demand. So anyway, they're raising VR prices. So that could be a way to get exposure to virtual reality. I wonder, usually this app, I wonder if we can find like the investment theme right here. See, this might be cool. So markets, stocks. Let's see if we can find virtual reality on here. Because there's a lot of cool sectors, or I guess virtual reality right next to it. So here's the virtual reality one. Oh, Apple, yeah, Apple has their own virtual reality goggles that I don't know. Guess they got Google in here, Sony, IQ. I've not heard of some of these, but hopefully that was kind of helpful. I don't know if it was, but yeah, thanks for that crane, dude. I appreciate you. We'll look at a couple more here. Then I gotta go. Dang, I've been streaming for almost like 3 hours. All right. At around 2 to 2.5K spending per daily. Potential less wrongful deaths. Oh, hey, what's up, Knowing? Philip Morris, interesting company in their transition. Oh, yeah, PM. This is a great dividend play. Yeah, we were looking at them earlier. So if you're looking for a nice high-quality stock or high-quality dividend stock, this one's a pretty good one because you get a 3.6% qualified dividend, and it's safe. They really only have like a 70% payout ratio. The valuation's fair. They only trade at 19 times forward PE or 19 times forward PE. So yeah, if we go to their Zen business or their free business right here, we'll call it. I have to be careful with what I say on TikTok because every time I cover this industry, I get in trouble. But yeah, it's growing nice double digits. It's up 12. Last quarter's up 17, 15. That's after grew 21. That's after grew 15. So nice, you're right. They're having a lot of synergies from Zen. I think they were an original spinoff from Mo Altria Group, which is another kind of high-yielding smoke business. DCA into SPYM and QQM, and you'll not be sorry. Yeah, exactly. Because for all of history, that's the way to beat inflation. Just buy QQQM, buy SPYM, which is just the S&P 500 and the NASDAQ. For all of history, they just return like 10, 12% of your money back a year. All right. Hey, what's up, Vulcan? He says SWMR. I haven't seen that one, I don't think. And then we'll do UNH after this. I don't have too much good things to say about that one. I see some other high yielding names here. So yeah, here's Swarmer stock. Looks like they just IPO'd literally 5 days ago. So yeah, this stock has only been, no, they've been out for like 2 weeks. So they haven't been public for that long, but they're worth 433 million. So just beware, it is a really tiny market cap, only worth 433 mil. Morningstar actually says they're undervalued. The company's proprietary autonomous drone swarm technology and narrow economic moat offer potential long-term value. Though its extreme uncertainty rating warrants prudent cautiousness. So yeah, you definitely want to be careful. Yeah, so for the full year 2025, looks like they only did 300,000 in revenue. But it looks like it's a drone concept stock right here. Okay, they're trying to steal my cookies. Oh well. So anyway, it looks like they have some Swarmer or 40 plus military units who trust this company. 100,000 plus combat missions flown. So I guess this is kind of what they do. Some sort of drone, drone warfare, a swarm of drones coming after your ship in the Strait of Hormuz or something. Anyway, some sort of drone warfare company. So this might benefit from ongoing war escalations or something. Any news? Nah, no news. But anyway, so they just IPO'd 2 weeks ago. So I wish I could give you more thoughts, but there was like no revenue data for me to look at simply because they just IPO'd, unfortunately. So what is Empire Sushi? Is that a stock or something? I see QQQI. Yeah, that's a QQQ covered call ETF. So basically, what is QQQI? It sells covered calls on the NASDAQ 100. And really, the NASDAQ 100 isn't something you want to sell calls on because historically you always get called on it. That's why, the NASDAQ from, this thing when it IPO'd was $53 in 2024, and it's still $53. So basically what you're hoping for is the stock stays similar and you just get the yield. So this company pays a monthly dividend. You get like a 13, 14% dividend. But historically, you don't get any stock price appreciation. So basically, you just buy this to maximize your dividend income. You're not going to outperform the S&P 500 or the NASDAQ, but you get the nice dividends. So UNH right here, United Healthcare, this one's just such in the government's hands. So let's see if there's any specific news. And well, basically they've been accused of overbilling the federal government and their margins have been inflated in the past because of this. So let me just show you why the stock is struggling right now. The margins just got hurt. So if we look at the revenue's up 12, but the net income is down by 96. And that's real as well. Like last quarter was down 50. That was real. So easy metric to understand. Gross margin. Gross margins are down 22% after it fell 9%. So gross margins are really like lowest ever. So lowest ever margins, and not just gross margins, but also net margins. So basically the reasons the margins were so good before today is because they really were like overbilling the federal government and prescribing people that back brace they didn't need and stuff for extra profit. So anyway, and again, we're a customer, we use OptumRx. That business is growing like crazy, but it's just like a low margin, super federally regulated business. So I would just be careful with that. And also, there's also a dividend issue. Like, look, last quarter they made 218, then they made 2.54 billion. This company pays a nice dividend, but every quarter they have to pay. Where's the dividend cost? Right here, 2 billion exactly in dividends. So the dividend cost in the very bottom, or in the very top, 2 billion a quarter. So they have to make 2 billion a quarter just for the dividend. So even though they made 200 million this quarter, they actually lost $2 billion because they had to pay 2 billion in dividends, but didn't make 2 billion in net income. But revenue is supposed to decline as well. Look at that. Revenue is going to go from 111 to 109. So organic revenue is going to decline. So it's just a future growth story on this one. But Warren Buffett likes this one. Warren Buffett bought the stock like half a year ago. But I'm just staying away from that industry. There's like it's Medicare, Medicaid, all that. And it's in every time the stock goes up or down, it's because the government either allows them or doesn't allow them to raise prices. Roth account needs ideas new to market. Yo, I have a Roth IRA. Here's my Roth IRA right here. Yeah, Roth IRA is just a tax-free retirement account. I'm a big fan of it. And you can actually withdraw the money early if you're a first-time house buyer. So if you've never bought a house before, you can withdraw your Roth IRA tax-free, penalty-free for a first-time down payment. You can also, if you have like a medical expense, withdraw it. But anyway, it's the single best way to also hand down wealth tax-free and stuff. So yeah, I love a Roth IRA. Just started mine a year ago. All right, yeah, let's look at a couple more here. Is this spot trading? How do I join? No, hey, no, we're just looking at high quality stocks to buy. We don't, this isn't I don't sell nothing. I have no course book. I don't coach. We're just on here giving my opinion, looking at stocks. Adam said Western Digital. Is that WDC? Yeah, we'll look at this one. Oh, and then Monster Beverage is a cool one. So here's Western Digital. This is, I believe, another one of the hard drive memory shortage plays. So yeah, basically they sell like SSDs, hard drives, external hard drives, stuff like that. Basically, you just got to look at the future growth projections. We go to net income right here. Yeah. And notice how crazy they've been beating on net income projections. They expected 647. They did 1.8 billion. Last quarter, they expected 516. They did 1.5 billion. So yeah, if we just zoom out on their net income, record net income these past 2 quarters. So I think the reason the stock is at an all-time high is because the actual fundamentals are at an all-time high. But that being said, I wouldn't buy this one at all-time highs. Certainly not. This is one of the most expensive memory shortage companies. Like they traded a 39 forward PE currently. The chart looks very similar to like a SanDisk, an SNDK, or like a Micron, where both oh my goodness, cannot type it in. There we go. SanDisk right here. Yeah, look at this one. The chart almost looks identical. This one's also at a crazy all-time high right now. So would I definitely wouldn't buy this one at all-time highs, but also I'd maybe trim a little bit. I'd maybe consider trimming a little bit. But yeah, revenue growth is really good for the future. But I think that one's a little more pricier than all the other ones. Look at BTI, could start a rebound. BTI, this is British American. Oh, okay. So yeah, another one of the tobacco stocks. This one's the same price that it was back in 2014, but these give you good yields. Like if you buy the stock right now, no matter what, you're getting 6% of your money back just in a dividend every year. 6% is crazy. Morningstar says they're fairly valued, robust pricing power in traditional combustibles, and successful turnaround of its U.S. next generation products business will generate long-term growth, though investors should wait for a more attractive entry point, they're saying. Okay. So anyway, yeah, they sell, or I can't get into what they sell, but yeah, they make a good over 1 billion of after-tax net income a quarter. We've converted it from British pounds to US dollars. So yeah, they're making over 1 billion net income a quarter, and you get the 6% dividend yield. And yeah, I guess the app was telling me there's some kind of technical analysis, or actually, I guess that's bearish. I guess there's a bearish continuation triangle, but anyway. T-Gun said Monster. I really like Monster Beverage right here. It's a phenomenal stock, and they've performed like a monster. If we zoom out on this chart right here, it's like one of the best charts ever. And if we go to their bottom line, they get so much free marketing from other people. But yeah, they make 500 million of after-tax net income a quarter, and they also have no debt. So that is such a huge safety net. The fact that they literally have no debt at all, ton of cash, making 500 million net income a quarter. Oh yeah, what are they doing with basically 500 million net income and free cash flow a quarter? They're mainly doing it, returning all that money to you as a shareholder in share buybacks. So they buy back their own stock every quarter. They beat on revenue every quarter. Like they expected 2.04, they did 2.13, and the analyst expectations are only up and to the right. Same with net income. They're gonna have a record net income, 561 million in 2 quarters. So yeah, Monster Energy's a beast. It's grown 19% after 5%. So yeah, they also own some other brands like Bang Energy. They actually, does anyone remember Bang Energy 5 years ago when it was popular on TikTok? They used the label on their can, Super Creatine. Monster sued them for $300 million. And then Bang Energy went bankrupt. And then Monster Beverage bought Bang Energy. Isn't that kind of crazy? But anyway, yeah, I love that business. I actually own the number one Monster bottler. I own the bottler for Monster, which is Coca-Cola Consolidated. Oh yeah, if you didn't know, Coca-Cola is the largest holder of Monster. Coca-Cola couldn't make their own successful energy drinks, so they're like, shoot, let's just buy Monster. So yeah, 21% of all the shares are owned by Coca-Cola for Monster Beverage. Kind of cool. Hi, what's your thoughts on Webull and how many shares do you own? Yeah, let's check out Webull really quickly. So Webull, I do own in my Roth IRA as well. They've had a phenomenal rally in 1 week. From exactly a week ago, they're up 41%. And I'm still down, but I'm only down 7.5% on Webull. But yeah, Webull is literally this app right here, publicly traded. So yeah, if you look at the very top of my screen, it says Webull at the top. So yeah, I'm a shareholder of Webull, and I'm a user of their platform. Here's my brokerage account with them. I'm only up 17% all time in here, but I'm just more bullish than the analysts are because right around after they IPO'd, Webull introduced prediction markets to the app, and I don't recommend doing prediction markets. It's where you can bet on basketball games. Don't do that. But whenever people do that, it makes the brokerage a ton of money. They keep a 2% fee. Whenever you buy and sell a stock, they only keep a 0.1% fee. Whenever you do a prediction market, they keep a 2% fee, which is 20x more valuable for their bottom line. They also just got into crypto for the first time ever. So you're not used to be able to own crypto on here. They're also collecting high margin crypto fees and prediction market fees. So that's my thesis on why I like Webull. And the SEC, the SEC just made a rule for the pattern day trading rule is now gone. So basically trading volumes are going to go up through the roof for brokerages. So that just sent all the brokerages up. It sent Robinhood, Webull, Futu, all the brokerages up on this pattern day trade news. I wonder if I can actually find that. Let's see. Yeah, so kind of the very first thing right here. SEC eliminated pattern day trader rule, removing the 25,000 minimum balance requirement and trade count restrictions. So basically, retail investors can do more trades now with less requirements. So yeah, that's the cool part about Webull. Let's see, are they expensive? I mean, the 45 forward PE, that is expensive, but they're also just now getting net income positive. But yeah, I'm not selling or trimming. I mean, on average, I bought all my shares still 7% more expensive than where it is today. I'm still down 7.5%. But anyway, I like Webull as a small position. You don't really want that one as a meaningful size position, but it's a nice one to own. And I'm just more bullish than the analysts are, and that's why I own Webull. All right. How much is in your Roth IRA? Yeah, not much. Check this out. Here's my Roth IRA, or there's my main account. Here's my Roth IRA. It's worth $6,700. We started our Roth IRA exactly a year ago. And yeah, we're down 1.8% all the time. I love being fully transparent. I'll share with you all the stocks that I own, how much I'm up and down and everything. So yeah. All right. Why do companies buy back shares? Is to return money to you as a shareholder. Whenever a company buys back their own stock, in short, it basically forces the stock to go up. A company can do a stupid buyback, but basically the stock, well, I won't get into that, but the psychology is basically if this company buys back their own stock, it forces the stock to go up. Yeah, so whenever a company buys back their own stock, it gives you more ownership in the company. So if you go to net income, like on Apple, net income is up by 15, but net income per share is up by 18 because the share part of the ratio went down. So when there's less shares that exist, it gives you more ownership in the company, literally leaves you more net income as a shareholder. If you didn't realize, like one share of a stock, like it's literally a real living, breathing piece of the company. If you technically one share of Apple makes you $2.84 in after-tax net income per quarter, or that quarter they made 284, 185. You're just trusting the Apple Corporation to reinvest all that net income, and they reinvest most of that net income into dividends or share buybacks is the way they return it to you. So anyway, I just love, I specifically only look for companies that do share buybacks, and every stock in here does massive share buybacks. All right, we'll look at a couple more here, then I gotta go. What is Rational? Is that a stock right there? Yeah, if you have a stock, please give me the ticker symbol. If you're looking for dividend, check out SEHD. Yeah, SEHD is a cool dividend ETF right here. Basically, it owns a lot of the like oil and like Verizon. Like, yeah, they got United Health Group, Chevron, Pepsi, Merck, ConocoPhillips, Verizon, Qualcomm. So yeah, it's a nice dividend ETF. You buy it, you get a 3.4% dividend. Historically, it doesn't outperform the tech-heavy S&P 500, but you just buy it to get higher qualified dividends. I had to switch to cash account last week. Thanks for the info. Oh, hey, nice, Matt. Share buybacks, does that mean dividends? Well, no. Actually, a share buyback is a dividend. It's just literally called a non-cash dividend, if you didn't know. So a share buyback is literally just a non-cash dividend. And basically, arguably, share buybacks are better for the shareholder because it's basically a tax-free dividend. It gives you the return via share price appreciation instead of an instant dividend, which could be taxed instantly. And basically, you can choose when to sell and take the gain. Yeah, like Apple right here. You won't believe this. So here's Apple. I'll be quick. They made $42 billion of net income this quarter. What is Apple doing with $42 billion of after-tax net income? Well, guess what they did? They bought back $24 billion of their own stock this quarter. Apple is the number one share buyback program on earth. They spend $100 billion a year solely buying back their own stock. For every year, they just buy back 20 to 25 billion of their stock every quarter. So that's why Apple stock never goes down, because like they bought back like 5% of the shares at $100, another 5% at 150. And then, so all the share buybacks they've done before today have been so accretive to current stock price. Can you do MELI? Yeah, MELI. This is like international Amazon. It's actually like a Brazil Amazon. So here, I'll show you that. If we go to where the revenue comes from, 52% of it comes from Brazil. Mexico's 22%, then Argentina's 20%. So yeah, it's like a South America e-commerce company, and you won't believe how growthy they are. This is the most impressive part. This is why I do like this one. The revenue growth is ridiculously good. Like every quarter it hits a record. This quarter specifically was a record. It was 8.8 billion in US dollars, up 44%. But there is one bad thing. Their margins went down. I don't know why, but yeah, gross margins fell by 5%. Net margins fell by like 20. So anyway, that was the one thing. So the revenue grew by 44. So revenue's up by 44, but the profits only grew by 8%. Like they still made 800 million, but the profits didn't grow as much as the revenue, meaning the margin slightly did go down. But that wouldn't scare me out of this company. They are, the tough reality is they're still expensive. Like even on this dip that they're having, they're not exactly like super cheap. They still trade at 37 times next year's net income, and they're having a lot of competition right now from Amazon. Amazon, I just read this like last week. Amazon announced a 1-hour delivery service for the top 10 cities in Brazil. And that's kind of what this company's doing. So almost I'd sadly maybe rather say I'd rather own Amazon. But this is like a pure internet, like a South America Amazon, which might offer more growth than Amazon. So anyway, hopefully that was kind of helpful there. Let's see if there's any. So Morningstar says they're undervalued. Rising e-commerce penetration in Latin America, powerful network effects from its integrated commerce platform, and rapid expansion in its fintech and lending business will drive long-term value growth for MELI. Yeah, check out their financial service business. That's a smaller part of them, but financial services revenue, I guess that grew 33%. Credit revenues, that grew 77%. So actually that grew very nicely. 37 forward PE. That's probably, that's fair for the growth that they have. So yeah, actually this is the second line right here. So the fintech segment grows 52%. Total payment volume grew 42%. So kind of cool. E-commerce and the fintech play. Intel, what's up? Tanza, Intel stock. Yeah, this is your American fab right here. So basically NVIDIA, Intel has the fabrication where they manufacture the chips, and Nvidia has agreed to move some of their manufacturing to Intel. And the government also just took a 10% stake into this company. So the literal US government owns 10% of all the shares. Basically, it's crucial that we have our own manufacturing capabilities. Right now, all of our chips are being manufactured in Taiwan by Taiwan Semiconductors. So it's actually like critical. The US can't allow them to go bankrupt. So here's Intel. And to please the regulators, Nvidia moved some of their manufacturing to Intel. But yeah, Intel and AMD face severe CPU shortage as AI demand drives a 15% price increase. So actually, one reason the stock's going up is because they're having price increases, which is pretty cool. Yeah, multiple analysts raise Intel price targets on strong server CPU demand and foundry progress. Kind of cool. So right now, if you look at the financials, they're not too good. Here's the biggest market share right now for GPUs, but yeah, PC GPU is 61% GPU market share. But if we go to their net income right now, it's kind of struggling from what it used to be. It used to be great when they had their Apple deal, making $5 billion in net income, $4 to $5 billion a quarter. Now it's just kind of a little choppy. But that being said, I wouldn't buy this one at its current price. I wouldn't even buy it even if it fell 10%. I'd be more comfortable around like the $45, $50 level. But I'm just staying away from Intel. I guess Morningstar's not too happy with this one. They say Intel is significantly overvalued. While the company benefits from government support and strategic partnerships to rebuild its foundry progress, severe manufacturing execution risk, market share losses to AMD, and the growing threat of ARM-based processor demand requires extreme caution. So I guess that's some downside risk. Yeah, there is no forward PE, so it's kind of hard to value this company on net income because they're not going to make net income for over a year. So it's kind of hard. There is no forward PE there, so it's kind of tough to value. So don't buy it is what I'm trying to say, unfortunately. All right. Sup, Nathan, which stock is your best stock? I'll share mine. Hey, yeah, let me know. My best performing stock ever is Powell Industries. We're up now 800% on this stock. I literally can't believe it. And I bought this stock, like people call me crazy when I first bought it. I bought it after it rallied like 400%. I bought it at here, and now they're up another 800%. I couldn't believe it. But my best money stock is Comfort Systems. We're up 15K on that stock, my best performing one ever. And if you didn't know, this is my never sell portfolio where if you're like, hey, are you going to trim that 800% gain? No, I have a rule where I'm literally never allowed to trim. So I'm not trimming or selling a single share. So yeah, we're just going to let it ride, diamond hand, see what happens. So yeah. Yo, Matt, we covered, the thing about BlackBerry is I'm not really blown away here. Lower than they were in 2007, but they're advancing their automotive business, their automotive software, and the U.S. Marines actually just took a interest in them. Or yeah, look at this. BlackBerry QNX partners with Marine Systems for global naval defense software integration. So they have this automotive software. That's the only thing they have now, because when we think of BlackBerry, we think of originally we think of their phones, and back in the year 2000, this was a $200 stock. Now it's a $5 stock. But basically you just value this company now on their software business. Yeah, if we zoom out to the revenue right here, it's obviously not what you want to see. That's why the stock has gone down so much, because the revenue is not even close to what it used to be. But they're potentially they've converted from a cell phone company to this automotive software business. And the cool part is they're really going to stay net income positive for hopefully every quarter from now on. They're going to make 11 mil in net income next quarter, 15 mil in net income. So they're going to be making over 10 mil of after-tax net income a quarter. Oh, let's look. Yeah, I wanted to get to Netflix too. Someone said, hey, what's up, Mr. Golson said PBR. What is PBR? This is that oil stock right here. Yeah, hey, congrats if you on this stock. Uh-oh, my stream is lagging. Hopefully it didn't just crash on me. Okay, it says we're back. Sorry if it just lagged right there. But yeah, this is a Brazil oil and gas stock right here. You basically buy this to maximize your income. Yeah, technically this stock is the same price that it was back in 2006, but a lot of people have crazy dividend yields on cost because every year they pay you it's a $20 stock and they pay you $2, $2.90. Dang, 2022 they pay you $6. They're paying you 10% of your money back a year in a dividend. The dividend changes every quarter based off how much net income they make. And as you can see by the stock price right now, I bet you they're going to print crazy net income in the next couple quarters because of the whole oil and gas issues. The price of oil has been through the roof since January, but it has come down. But yeah, that one has been benefiting from the high oil prices. They're going to probably print a bunch of net income and can pay out that in dividends. Intel last earnings lowered the outlook The only fools buying after the company lowered the rest. Yeah, I would not buy Intel at current prices because it is at an all-time high pretty much, or multi-year high right now. Stack Industrial, this is a warehouse REIT right here. So yeah, this is a real estate investment trust, which means they have to, by law, pay out 90% of their taxable income in the form of a dividend. So the reason they have a 4% dividend yield, and it's actually totally sustainable, is because they're a REIT. So most of their 90% of their assets are real estate. So they own the triple net leases for a bunch of warehouses. So this is specifically a warehouse REIT. Wonder if we can find that one. Yeah, they focus on, let's see, here's some, they got 601 buildings. Wonder if we can find like an investor presentation right here. But anyway, you can kind of get the point here. They own a bunch of warehouse triple net leases and they pay a high dividend. So here's the number you do a dividend payout ratio from. So this quarter they made 104, or on average they're making like 115 mil a quarter. And the dividend cost every quarter, 71 million. So yeah, they definitely can afford the dividend when you do a AFFO payout ratio. So the dividend costs 70 mil and they're making over 100 mil. So they're good. They're chilling. Another great warehouse robotics or warehouse REIT is PLD, Prologis. This one arguably is higher quality. They acquired Duke Realty. They own some of the best warehouses. But yeah, PLD is great too. All right, one or two more here. You prefer stocks over ETFs? Nah, I recommend keeping the backbone of your portfolio in a high quality ETF like a S&P 500 or a NASDAQ 100 or even like a Berkshire Hathaway. Because most retail investors can't outperform the S&P, but if you have it as the backbone of your portfolio, then play around with some individual names. I think you'll like that. Speaking of warehouses, let's check out a warehouse robotics stock. Yeah, thanks Blair for this stock right here. So Symbiotic, this is a warehouse robotics company, and some of their biggest customers are like Albertsons, Walmart. Actually, Walmart is their biggest customer, but they have over 1,500 registered IP and patents, and they have real revenue. So let me show you. Yeah, so basically they have these robots right here that work the warehouse. I kid you not. They whenever someone orders something, it takes it off the shelf, brings it to you, organizes it in the right place. So literally they have the software for it as well. So this is like a real robotics company. Like there's a ton of crappy robotics stocks like Rich Tech Robotics, Serve Robotics. Like stay away from those. Buy the one that already has the patents and the revenue and the customers. This company did 630 mil of revenue, up 30%. After grew 35, after it grew 60%. So check this out. If we go to the shareholders, this is another super impressive thing. Walmart is their largest customer, and Walmart loves them so much that Walmart decided to buy shares. Walmart owns 12% of all the shares that exist on Symbiotics. So Walmart's the second largest shareholder here. I love the revenue growth. They're just now getting net income positive as well. So I really like this stock. Yeah, look at the net income projections. They're going to make 22 mil, 25 mil in net income. They're literally from now on going to be consistently net income positive because it used to be kind of choppy, but now they're going to be making good net income. Revenues up and to the right. So that's a real robotics play. Hopefully you found that one useful because that's one of the best like robotics company. The best robotics stock, to keep it real, is Amazon. I've seen robotics. They're the best, but this isn't like a pure robotics play. Symbiotic is like a pure robotics play. XOM, yeah, ExxonMobil, and I see AutoZone too. That's a cool one. So yeah, ExxonMobil, this is your oil and gas play. This is like the most quality oil and gas stock to buy. It's historically, whenever oil goes up, ExxonMobil goes up more. Whenever oil goes down, historically, ExxonMobil goes down less. And they're actually, I think, like the best performing oil and gas stock, like mega caps. So yeah, can't go wrong. You get a good dividend. You don't have oil as a meaningful size position in your portfolio, but you'd own it for its diversification. You own it as a little chunk of your portfolio for environments like today, where the Strait is being closed and oil prices are surging. And whenever there's war fears, it's kind of like a safe haven asset. So oil's cool, but as like a diversification hedge, you don't want it as a meaningful size position, but you own it for environments like now and for its dividend. While in the meantime, while you're waiting for that stuff to happen, you get a high yield. So I saw, can you do Shopify in advanced AutoZone? You mean advanced auto parts, or is that AAP or? Yeah, AutoZone's the best one. AutoZone is the best one. Advanced Auto Parts is pretty junk. But yeah, look at AutoZone's stock price. This is incredible. And if you're wondering, why does AutoZone stock grow so much? It's solely fueled well, not solely, but almost all the share price appreciation is fueled by stock buybacks. If we look at the top here, they spend for all of history, we can zoom out, 2024, 2023, they spend billions a year solely buying back their own stock. Like they bought back 5% of their shares in 2021, another 5% in 2022, another 5% in 2023, another 5% in 2024. So every year, if this company paid a dividend, instead of doing share buybacks, if they did a dividend, you get a 5% yield. But instead of giving you that 5% dividend in terms of cash, they give you 5% more ownership in the company every year. And that's what I love companies that do both, but mainly share buybacks. Like which one would you rather have? If they're going to give you 5% of your money back, would you rather have it in just cash? Or would you rather own 5% more of the company? And then that snowballs every year. So when they pay dividends the next year, they cost less. And so anyway, AutoZone, O'Reilly Parts, whenever they make net income, like 500, 800 mil a quarter, they just return it all to share buybacks. Pretty cool. O'Reilly's another one that almost looks identical. Just phenomenal stock price appreciation. The one that doesn't look phenomenal is Advanced Auto Parts. Same industry, but look, Advanced Auto Parts is trash. They're the same price as they were back in 2009. Anyway, AutoZone's cheap too. You'd think AutoZone's expensive. They only trade at, 21 times next year's net income. That's pretty crazy. Oh, I don't know what I just clicked there. But O'Reilly's a really cool one. O'Reilly as well. All right. Hey, what's up, Rolando? Afternoon, bud. Can you look at PAC for me? And thanks. Have a great week. Hey, you too, man. Dang, I've been streaming for 3 hours and 3 minutes. Let's keep going here. So here's Pacific Airport. So this is a Mexico airport play. Actually, this is done really good. I'm not a big fan of the airlines, but you know what I'm a fan of? The airports. This is actually the company that owns the airports. And every time you go to an airport, Starbucks, it's always like 50% more expensive than a normal Starbucks because there is no alternative. You can't bring in food and drinks. So they have incredible merchandise margins. So, airports are milking us. But yeah, here's their net income. Consistently making this is in US dollars. We've converted it from Mexican pesos, but yeah, they're making 150 mil in net income a quarter. And the valuation, what do they trade at? They trade at only 16 times next year's net income. So yeah, 16 times forward PE, not too shabby. You get a dividend, you get a 3.7% dividend. There's another one. It's O'Hare Airport. I don't know the ticker symbol, but there are some other airport stocks that I do really like. There's no way I'm going to find them in a relatively quick amount of time, or maybe I can. Here's kind of my recent watch list. Because I remember I was digging into all of them. I was like, dang, all these airport stocks are printing money. And here it is, CAAP. So look at this. Here's another airport stock. It's moving like a freaking NVIDIA. Look at this. This is an airport stock, CAAP. There's also OMAB. So here's what it was called. I think this is another Mexico one. But anyway, I don't know why I found these industries so interesting. And maybe you can, this is the America one. So this is Corporacon America. These are the American ones. And they look at the forward PE. This one only trades at 11 times forward PE. No way. CAAP. So we just saw the Mexican one trades at a 17 forward PE. Well, CAAP might be growthier. And look at their forward multiple. They only trade at 11 times next year's net income. So here's maybe another one you could put on the watch list. Yeah, look at their revenue projections. They expected 483. They did 550. I own OMAB. I need to look at cap. Oh, hey, there you go. Nice. Airports apparently going to the moon. Yeah, Axel, I don't know what's up with that. That was kind of crazy. All right, we'll do one or two more here, then I got to go. Or yes, he said CDNA. Let's do CDNA because my phone's about to die. I realize. So, and then we'll get to, is Google too expensive? A little bit, yeah, unfortunately. Oh, I saw Datadog too. Are you still in here, home? We'll do Datadog. So here's CARE DX stock. This is a $1.1 billion company. Looks like there was some sort of news a couple of days ago that sent the stock gap up. Okay, so they rise after agreeing to divest a business. So they're selling out of one of their own assets, apparently. So that might be why the stock is rallying. I don't know. So the revenue was $108 million, technically a record, so $108 million of revenue, but they're still losing money every quarter. They have narrowed their losses, but yeah, they're losing $7 to $10 million a quarter. So that might be the bad news. Well, $1.1 billion company, but I wish I could give you more thoughts on this stock. It's just some, I guess, biotech, diagnostic, research company. Maybe we can check out their website right here. Together and Transplanter. Maybe the CareDx is a leading provider of transplant-focused solutions, digital tools and services that help them through their journey. Rejection monitoring test performed. So anyway, it looks like they're selling these like tests or something like that. Transplant test, something like that. Kind of nichey. I don't know. Revenue projections are good. Revenue is going to go from 86 mil to 108 mil. And they're barely going to lose money. They're only going to lose 650K on that, according to analysts. So yeah, it's kind of like a mixed bag. I'd keep it as maybe a really small position. I'd still be careful with that one. So Datadog, yeah, my phone is on 2%. All right, it's the last 2% that'll hit different, hopefully. So here's Datadog right here. This one just got, well, not just, but they're in the S&P 500 now. All right, is my phone slowing down? I can feel the battery like, okay, so Morningstar Research, this company has a wide moat, increasing complex cloud and third-party applications. I guess here's what the bulls are saying. Datadog's cloud-neutral approach and unified topology reduce cloud vendors. See, I don't know what half those words mean. But anyway, they are struggling with profitability. So yeah, they have phenomenal revenue growth. Check that out. Every quarter, the revenue hits a new record, and that's really what you want to focus on, the revenue. So congrats on the revenue growth. But for the past 4 quarters, they've actually, well, not 4 quarters, but they've been struggling to stay net income positive. I don't want my phone to die on me. I got my charger right here. Okay, here we go. But yeah, anyway, that's might be what makes it. That's what's making the stock struggle. It's like these are all like year-over-year declines. Like they're less profitable than they were at the same time last year. But they have great revenue growth. But that might be why the stock and all of software is off its all-time highs. But I don't know. This one could be like one that benefits from AI more than gets hurt by AI. Like, I wish I could give you more thoughts on this company. I don't know if they're in like cybersecurity, data management. Morningstar has a lot of words that I don't know what they mean. So like Datadog's telemetry orchestration creates a unified environment that allows AI agents to operate freely within an organization. We expect the enablement of AI agents to be a major revenue driver. Datadog, well, here's what the bulls are saying. The competitors Dynatrace. Do you day trade any stock or the S&P 500? Curious. Thanks. Hey, what's up, Wolf of Wall Street? I actually don't really trade. I mainly just buy and hold great stocks. Yeah. John says dividends are safer. At least you can get something. The key is if a company can grow faster. Yeah. Actually, I every stock I own pretty much pays a dividend. No, but here I'll show you. Every stock in here pays a dividend. Every single one of these. Every stock in here pays a dividend except for Amazon. Amazon's the only one that doesn't pay a dividend. But yeah, I love companies that just return money to the shareholder, like already profitable companies that have so much leftover money they can do share buybacks or dividends. And if they don't pay a dividend, I buy them probably because they're doing share buybacks, like AppLovin, buybacks. Reddit, just incredible growth. Or it's either super growthy or like Reddit, Dave, like these are just really growthy where they don't really need to be doing share buybacks or dividends. Kind of like Amazon. Amazon doesn't do dividends or share buybacks. They just invest it all into the future. Or do like synergistic M&A. And that's another great way a company can return money to shareholders is by returning money to the shareholders by doing synergistic M&A, mergers and acquisitions. Like Cover Systems, historically, 80% of the money they make, they return it to the capital via doing acquisitions, and then 10% dividends, 10% share buybacks. Kind of cool. Yeah, that was a crazy rally, George. Good to see you. Do you also hate tax season? Actually, I don't have to pay taxes until October. I get a legal delay. But yeah, I hate tax season for sure because it prevents you from investing more into stocks. Google will be growing. Yeah, I guess last thing will go is Google or SP. I apologize I joined late, but you have accounts for never selling them or others. Or yeah. So it's just my own little portfolio. I just do this for fun. Like this portfolio specifically you're seeing, it's called my buy and never sell portfolio at the top because once I buy a stock in here, I never sell it. It's just my own personal thing I do. And then this portfolio, if you look in the top left, it's called dividend only because every stock in here pays a dividend. So it's like my dividend only portfolio. Although most of these, if you notice, are like dividend growth stocks like Meta, Google, have with really small yields, but it makes up for it in terms of the growth that they have. Yeah, Google's another phenomenal one. I saw some people asking about Google. This will be the last stock I analyzed. Then I got to go. But this has been such a fun stream. I've been live for 3 hours and 20 minutes. If y'all want to hit the follow button, I stream every day. I stream every Sunday, this exact same time every Sunday. If you're free, I sell nothing. I have no course, book, WhatsApp, Telegram. I don't coach. I don't teach. I don't do nothing. Just on here giving my opinion, and none of this is financial advice. I'm definitely not an expert. But if you want to support me, the only way to support me, if you wanted to, is just hit the like button and follow my YouTube channel. I'm trying to build up my YouTube subscribers on my YouTube channel. So if you want to help me out, subscribe to my YouTube channel. It's called Nathan Robert. It's also in the link tree in my bio. You can just type into YouTube Nathan Robert. If you hit the subscribe button, leave a comment, that'd mean the world. But anyway, let's analyze Google here. So Google, they actually are a big space play. If you didn't know, Alphabet owns 6.1% of SpaceX, and it's potentially worth $100 billion. If you read the second line, that's on an original investment of only $1 billion. So they bought SpaceX when they were valued at $12 billion. Now they're potentially going to IPO at around $2 trillion, which is just nuts. So big space play. That's a way to get exposure to space. But yeah, some other good news. This is a huge advertising play. You know, YouTube, Google search, they have still a 90% global search market share. And they're also a big AI play. Google Gemini is like just as good as ChatGPT and has just as good, same amount of daily active users and stuff. So yeah, Google Gemini is huge. Google Cloud is huge. Yeah, they have robotaxis. Yeah, Waymo opens robotaxi service in Miami and Orlando, begins highway testing. Google sells TPUs. Google sells their own chips. Like Meta just bought like 2 billion of their own chips. So yeah, I have no bad things to say about Google, except they're a little expensive, but not even that much expensive. They only trade at a 29 forward PE. So only 29 times next year's net income. Still pricey, but not that expensive for the quality and growth that they have. You know, Google Cloud, the year-over-year growth rate was 47. You know, after it grew 30, after it grew 22. So the Google Cloud business is an insane grower. Here's their net income every quarter. If we just zoom out, record net income, they're doing over 30 billion of net income a quarter now. They did 35 bill, or look what the analysts project. 31.7 bill next quarter, 33 bill in net income the quarter after. And with all the AI and stuff, they've been beating on net income every quarter. So yeah, this is literally just a behemoth with quantum chips, TPUs, robotaxis, AI, cloud, advertising, YouTube. Yeah, YouTube raises subscription prices for the first time in 3 years. Actually, on my Discord, I was just doing a little breakdown on this. This is actually pretty cool. I was going to the random news here. Oh yeah, and I was breaking down this too. Yeah, Google bought YouTube for just $1 billion. Now it does $60 billion a year. But Google just rose their YouTube premium prices for the first time in 3 years, and assuming no incremental cost, like their cost didn't go up, that makes them now 700 million of after-tax net income a quarter from now on, just from this YouTube price increase. I pay for YouTube Premium. It's one of the few subscriptions I actually genuinely love paying for. Like Google and YouTube Premium has the pricing power. I'm not going to cancel my YouTube Premium just because it went up by a couple bucks. So, dang, dude, my charger is so broken. It just like doesn't want to. Well, anyway. Hope you guys have a great rest of your Sunday. That ends the stream. I'll end it with a quick portfolio update. But yeah, again, if you want to support me, please hit the like button. It still help me out. Subscribe to the YouTube channel. Oh, yeah, I have a Discord too. I used to have the Discord for free, but a ton of scammers joined. But basically, I made it the least amount of money possible. If you wanted to join the Discord, and it won't even give you that much value. But if you wanted to join the Discord, it cost $1 to join. Or if you become a YouTube member or a TikTok member, you get instant access. But again, you just pay $1 or become a YouTube member. You can cancel right after, and you get permanent access to the Discord. But don't expect much value. I don't know if you'll get your dollar's worth. Anyway, see you guys. This is my portfolio. This is my buy and never sell portfolio, where once you buy a stock in here, I never sell it. Oh yeah, if you want to join the Discord, it's in my link tree or it's in the description there. You'll find it if you want. But yeah, all time, this is what's crazy. We're up 320% all time. And mainly it's just the past year, that's all the gains. You know, just exactly since 1 year ago, we're up 185%. And the NASDAQ's up 50, so we're actually done a lot better than the NASDAQ. But even if you just bought the boring NASDAQ, they're up 50%. Yeah, I'm also streaming on YouTube. Yeah, my YouTube channel is also in the link tree in my bio. It's called Nathan Robert. I'm also streaming on there. YouTube stream stays up forever on YouTube. You can like rewind it. But yeah, that's this portfolio. You know, I got some nice names in here. Amazon is what we were recently loading the boat on. We bought like $1,600 of that 2 weeks ago, and now it's finally having this insane recovery back to all-time highs. So yeah, that's that portfolio. We also have a Robinhood account, just called our dividend-only portfolio. Year to date, we're up 0.03. The past year, we're up 33%, which does underperform. The S&P 500 is up 35. The NASDAQ's up 50. We're only up 32% in here, but hey, I'm not complaining over 32% gains in a year. Here's our total percent change in every stock. So luckily we are green on every holding in here. Google, McDonald's, Meta, invest in what you use. McDonald's is really a real estate royalty company. They own the land and they own the real estate and they collect royalties from all the stores. So they have insanely high margins because they're not really a restaurant. We also have a Roth IRA, kind of not done too well. We started this exactly a year ago, and we're down 1.8% all the time. But yeah, we're trying to bring the growth back. We bought HCA Healthcare. Weeble's been recovering. CareTrust, this is our newest position in here. CareTrust Senior Housing, Skilled Nursing, Real Estate Investment Trust, 3.8% dividend yield, and they focus on senior housing care facilities with people with dementia. So I don't know. It's an interesting industry. And then Webull account right here. I have no real role in here. I kind of just do whatever I want in this account. We're only up 17% all time in here. But yeah, here are all the stocks that we own in here. I got some popular names like AMD, Microsoft, Uber we just bought, Reddit, Progressive, AbbVie, Zoom, we're down bad on Zoom, SoFi, Robinhood. So yeah, that's all of our portfolios. Over the past year, though, this account is up 44%, and we've gotten $209 in dividends. Actually, a lot of that dividend just came from this one-time special payment from Progressive. But anyway, see y'all soon. Hope you have a great rest of your Sunday. Sorry if I missed any comments here. See you later, Michael, Henry, John, Wolf of Wall Street, George, Rolando, and Yessie, Mira, Michelle, Matt. Sorry if I missed. Oh, SPG. I forgot to get to SPG, Matt. Please forgive me. But anyway, see y'all soon. Again, if you want the follow button, I sell nothing. I have no course book. Just under giving my opinion. See you soon. Thanks everyone on YouTube. Yeah, this is one of the best streams I've ever had. TikTok didn't frickin' remove my stream from For You. Actually, they removed my For You page eligibility like 30 minutes ago, but it was okay because we still had decent viewers. But anyway, that was one of the best streams I did. Thanks all for being here. See ya.